Let us start with a small prayer. Namaste. Good morning. Friends, welcome to this classes, which are some special sessions. As we had told that this is to commemorate our 20 years of existence. We at Bharatwaj Institute is there for here 20 years now. So we thought we will provide some classes which benefit the students, and only one subject I know. I thought I can provide that classes to you. So this is direct taxation classes, and I named this classes as direct to examination classes. I named this classes as direct to examination with the single motive. This class is with a single motive that you should score exemption in your examination. Without wasting much time on the other aspects of introduction, as the class goes by, we will see those things. I want you to understand something. Though the subject is voluminous, there is no question of the length and breadth of the subject. But examination focuses on certain clear areas. There are some areas where examiners and examination gets focused. And that is what we are going to, surely out of experience, we understand that. And to a larger extent, 80% of this paper comes from that aspect of it. 80% we can very easily predict. 20% is the area of variation. So our classroom is trying to address 90%. Our classroom will ensure that we address 90%. Okay. Leaving the rest 10% with the belief that whatever we have covered will be asked only. But there is always, I don't want to give you a false confidence. But by attending these classes, I am very sure 90% of the syllabus gets covered, so that you can face your examination with confidence. As I said, as the class goes by, other instructions I will keep giving. How to prepare after the class, how to prepare before those 45 hours which you have between the previous exam and our exam, in between to 1.5 or less than 2 days, how to prepare. All these things, as the class goes by, I will keep telling you. Well, how does the classroom travel? Is this going to be what is known as a fast track class? I want to remove that. No, it is not a fast track class. Is it going to be a revision class? No, it is not a revision class. Revision class requires some 30 hours. We are going to go for almost 15 to 16 days, almost 100 hours. So it is not a revision class which I am making. I am giving you in-depth knowledge in some very important areas. Okay, very important areas. I'm going to give you in-depth knowledge. So a newcomer, a new learner can also understand. If you are new to taxes also, if you have not previously prepared also, fine with me. You can definitely understand. If you are previously prepared, you will get more confidence. After all, examination is an exercise of confidence. I always feel the biggest difference in our examination is not lack of preparation, it is lack of confidence that we have prepared well. And that confidence sometimes, that lack of confidence only puts us down, and not lack of preparation. That also during the classroom I will establish Why I am saying so? What makes me say so? So, the classroom travel, as such, the classroom travel is going to be like this. The classroom travel is going to be like this. I start with PGBP and we cover it 100% because this chapter is going to come till the last class. This is one chapter which we are going to see 100% end to end. We will see this chapter, so that this chapter is going to travel with us for a very long time. Then comes capital gains. Then comes capital gains. One other chapter which is which can have a standalone question. Capital gains is a chapter where we can have a standalone question also. I will briefly touch through IFOS. Capital gains again I want to cover 100%. IFOS and some business oriented deductions. Okay, we will because you should not be thinking that IFOS is not a very important chapter at the entire level. No, it is not. It gets its importance. It gets its final level. It gets its importance. Okay, and then goes the chapter, the assessments. Then goes the assessment, firm, company, okay, charitable trust, individuals. Okay, in this, the first three, again I will tell you 100%. An individual, I'll just browse through because we don't have salaries. We don't have a house property as a chapter. But where exactly salary or house property can come is in DTAA oriented questions. In non-resident questions, this will be tested. So I am not saying it will never come. Okay, but we should have a reasonable knowledge of it, which is what is focused upon. Which is what is focused upon. And while this part of it will give you a 40 to 50 mark coverage. Of course, there is no doubt international taxation, again 100% coverage will give you some 30 marks. Then what is remaining? Assessment procedures, TDS, TCS. Okay, these are all the topics. Again, assessment procedure. We can pick and say where the questions are going to come from. For example, block assessment is a new arena. It's an amended arena. Penalties is an arena of question. 270A is an arena of question. Reassessment procedures is an arena of question. And TDS, TCS, 100% we need to cover because there is 8 marks in that. There is 8 marks in that. So that I am very sure, pretty sure that 90% of the syllabus is going to get covered in our classroom. 90% of the syllabus. And when I say coverage, whatever I have written 100%, I will take the class as if you are new to taxes, as if you are fresh to taxes, and I'm not going to do not believe that I'm going to rush and all. Okay, I'm not. It is not a fast track class. At the outset, I want you to understand I am, and I enjoy this subject like anything. Not paying but teaching. Okay, I enjoy taxes like anything. So we will not be rushing at all. We will not be rushing at all. For those who have, I've already put a lot of instructions and I insist on those instructions again, those who are online and those who are here. I always believe somehow maybe the school of thought is something which is little old. Why I am saying little old is pre-COVID we are all same. Post-COVID things have changed. But I always believe coming to classroom and understanding will be much better for those who are in Chennai. Okay, I always feel that there was an inter-student who is residing in Nungambakkam, who opted for live online. I called him and said, you are in Nungambakkam, okay, 2 roads away, okay. So I always feel if the only thing you need to fight it out is your laziness, if you think that you are saving time by not traveling, I assure you that you are you are using that time to attend it more in a vibrant manner. Of course, that doesn't mean that live online or any other persons will get affected. It will be the same experience which the classroom people will have, almost the same experience. But I still insist, if live online students, if you can come for a session of physical classes, come. Otherwise, fine with me. And for those who have, I have already put this instruction also. You should definitely have 2 notebooks. And that is a fundamental requirement. You should definitely have 2 notebooks. One for exclusively taking down the theory and another for practical material. Now, I'll come to this theory material. Now, for those who have subscribed, you would have got the material, or the material should be is already couriered. You should get it anybody. Those who are there in the classroom, if you have subscribed for material, during the break we will go and get it from the admin people. For those who are having the theory material in your mobile or in your laptop, okay, there are 2 materials provided to you. One is an exclusive theory material which has the holistic theory, whatever we are going to discuss in the classroom. Then why do I insist that you should have a separate theory notebook? In the notebook of the classroom, I am going to further condense the theory. I am going to condense the theory so that a browse through of it, you will remember the provision. So the theory material travels like this. We are going to write it in the classroom. Why are you making us write? 2 reasons. One, condensing. Is the main reason for me asking you to write. But there is a second important reason which I want to be loud and clear to you all. Majority of our friends have this feeling. They are unable to complete the question paper. They are unable to complete within the 3 hours the entire question paper. In fact, it is more in FR. Okay. Apart from the question paper being lengthy, there is one other reason for it. During our articleship period, we are losing the habit of writing. Everything becomes a laptop. Everything becomes a mobile. So the habit of writing is lost for 2 or 3 years, as the case may be. Suddenly, when you are back to the classrooms, suddenly when you are going to the examination, the same habit of not writing, in your interview would not have had the complaint. It is not that inter paper are not lengthy. It is that from school, from college, you had that habit, you continued the habit of writing. But during this interim period, you lost that habit of writing. Now, I want to establish that once you start writing in the classroom, that habit will get developed. So, I am going to make you write the theory, make you write the solution fully. And it might be an age-old concept, but it has been very firmly put into my mind by my mother that writing once is equal to reading for 10 times. So, I am going to make you write. You are going to have a theory notebook, even though there is a theory material. You are going to have a theory notebook. If you are, after writing in your theory notebook, if you are not very clear about what has been written, when you look at the practical solution which we have done, you will become more clear about the theory, what you have written. If you are further not clear, then go to the material. See what the material will have a detailed analysis. The material will have a detailed analysis. At that time in the material, you can check it. If that is also not understandable, then the helpline is always there. That is, you have to call me or text me. Okay. So in that manner only, the classroom is going to travel. So the theory material, even though if you have not subscribed also, if you are keeping it. But I wish, this is again a request, I wish that you have the practical material in your hand. You have the practical material. I probably again here I definitely would say that I still read books only by holding the book in my hand, and I am unable to read it in Kindle or any other app. It might be the same, but if you have practiced, fine. But I always feel keeping the material in hand, highlighting some of the aspects will be of importance to you. If you still want to get the practical material, you can contact the office admin people. But if you feel no, I can manage it, I leave it to you all. That's it. Okay. Well, from here, I know some of you already know me. For those who don't me, there are 2 or 3 things which I want to tell you very clearly. That is, one, the most toughest thing to even understand or even look at is my handwriting. It is not that I don't know that. Okay, it is very difficult, but fortunately, by God's grace, I cleared the examination. So as of now, I don't have the intention of buying that 4 ruled notebook and writing it. So please, I am putting it on display also, this handwriting. So manage with it. Okay. And I don't have any hesitation. If you ask me whether what you have written is B or P, I will not even have any hesitation. So you don't worry. But it is going to be poor. Get ready for some 16 days of poor handwriting. Okay, that should not give you a false confidence that with this handwriting we can clear. Okay, at that time it happened. That's all. It's a miracle that happened. Okay, that is something which I want to give you. And the classes are spanning from 6 a.m. and it will start at 6 a.m. and somewhere around 12 to 12:30 we will complete the classes. So if at all those who are going to offices, please get the permission till 12 o'clock. You can leave after that and join. Anyhow, Madam G is very fond of our classes. She postponed the due dates already to September. So exactly on the date you are writing the examination in September, you will have the due date also. So you will not have any problem of due date pressure. And the third thing before entering into the main aspect of PGBP, the last of the thing is the material covers everything. The material covers everything. Okay, that is more than sufficient. But apart from the material, I will look into, after completing at a particular level, we look into the RTP. We look into the model test paper that is released by the institute. That's one good thing the institute has done. If you do those things, it's more than sufficient. So we'll do the model test paper. We will do the last, because I think mock tests are only starting late July. If our DT mock test is over of September, we will look that paper also. Okay. With this, I'm going into, without wasting time, I'm going into profits and gains of business or profession. Profits and gains of business or profession. Profits and gains of business or profession. This is where we start our classes. Okay, it almost covers section 28 to 44. It covers section 28 to 44. Okay, my dear friends, let us understand the heading so that we are more clear about the chapter, what we are going to study. Profits. What do you mean by the terminology profit? Revenue from recurring activity. We call profits as excess of income over expenditure. Revenue from day-to-day activity, recurring activity is known as profit. What do you mean by gain? Revenue from rare or isolated activity. What do you mean by gain? Gain means revenue from a rare or isolated activity. Normally, my dear friends, the isolated activity revenues will be taxable only under capital gains. Normally, one-time revenues, if I sell my land, if I sell my jewelry, if I sell even shares, normally gains are consolidated to a chapter called capital gains. But this chapter is going to tax some of the gains also. Very soon you are going to see. This chapter is going to tax some of the gains also. That is why the chapter heading itself has the word gains. That is why the chapter, not only profits is taxable in this chapter, some of the gains, which we will very soon see, some of the gains will also be taxable in this particular chapter. So profits, gains of business. What is business? Trade, commerce, manufacture. The terminology business means trade, commerce, manufacture. Trade, buying and selling. Commerce, all the service sector, including banking, transportation, insurance, everything. Okay, manufacturing, conversion of raw material into finished product, manufacturing. So, it is revenue from trade, commerce or manufacture, business. What is profession? Profession is knowledge through education. Lawyers, doctors, chartered accountants, cost accountants, company secretaries, consultant engineers, knowledge through formal system of education. Okay, exhibition of skill. All artists comes under this. Exhibition of skill is also profession. Okay, okay, I am also taxable under business or profession because I am a chartered accountant. By knowledge I got it. Talevar is also taxable under business or profession because he is the most skillful artist I have ever seen. Okay, so knowledge acquired through education, exhibition of skill, and then the court has said vocation will also be treated as profession. Profession includes vocation. Vocation is a very rare combo of both the skill and education. Plumber, electrician, mechanic. We cannot say there is no education involved. There is a training involved, there is a methodology involved, but it also has more of skill set. It also has more of skill set. And to be more clear, people who earn revenue by preaching are all considered as vocation. Okay. I need not give you a lot of examples. People who earn by preaching, by talking. Okay, right? And they said that no, this is a donation given to us by our followers. No. Just because they are followers and they give you donation, it does not mean it's a capital receipt. It is a revenue receipt. It is taxable as donation. And I don't know how many of you know this. Okay, I don't know how many of you know this. This is a judgment in the case of Nityananda, who said, my followers are giving me donation. Why should I be taxable? It is a capital receipt. It is not a recurring in nature. But the court said, no, you are earning out of preaching. Okay, who? Nityananda. Okay, is earning out of preaching. So it is taxable. So this chapter is, by the heading itself, it has a very, very huge thing. That is, it is going to tax the profits that is arising from business and profession. It is also going to tax the gains that arises from business and profession. That arises from business and profession. So as a topic itself, it is a deeply dived topic. Am I clear to you? Am I clear to you? Okay. So this is the heading of profits, gains of business or profession. Now, this is not for your writing sake. This is for your understanding sake. How is this chapter approached by the income tax department or income tax law? How is this chapter 28 to 44? Okay. This is not for your writing. Later, if you want, you can take down. Now understand. Analysis of the chapter. Okay. Believe me, there are only two sections which speaks about income. 28 and 41. These are all the two sections which speaks about income, my dear friends. Okay. 28 and 41 are the two sections which speaks about income. Income is spoken about in section 28 and 41. You will be wondering that section 41 is deemed income. So which means 28 is the section which speaks about income. 28, the charging section here, gives us a list of incomes. Okay. And the expenses sections are 30 to 37, 40 and 40A are the primary expenses section. Why I am dividing it into two is 30 to 37 speaks about expenses that are expressly allowed. 40 and 40A speaks about expenses which are expressly disallowed. Directly you say in between there are two sections which are not there, 38 and 39. 38 is there, but it is little dormant. It is not a very active section, but 39 is not there. Inside 30 to 37 itself, 34 is not there. After 30, 31, 32, we will go to 35. 34 is no more there. Why I am giving you this is, we always think there are so much. There are also a lot of removals. Okay. Then comes the support section, which I call it as a support section, which is 43. Even though one part of 43 speaks about expenses, 43 is more of definition. What is block of asset? What is plant and machinery? What is forex treatment? What is contract expenses treatment? All these things are set in 43. We can call it even as a special provision, but in that is there is a 43B which speaks about expenditure elements. In that there is a 43B which speaks about expenditure elements. Okay. When I look at section 44, it is divided into administrative provision and presumptive computation. Administrative provisions are maintenance of books and mandatory audit. Presumptive computation, computing without maintaining any books of accounts, computing income on an assumption basis. This is the division of this chapter. This is how the chapter is divided. So the income section, let us leave the presumptive income section. Income sections are only two, section 28 and 41. Okay. In that expenditure sections, I can name those expenditure sections which you need to understand. Okay. So It is a lengthy topic, but it is easily can be condensed and read without missing any part of that chapter. Without missing any part of that chapter. Okay, right? Okay, friends. This is the analysis. Without wasting any time, I'm going into section 28, basis of charge. Section 28. Okay. Section 28, basis of charge. Okay, shall we? Okay, friends. 1. Profits and gains of business or profession. Profits and gains of business or profession. Profits and gains of business or profession carried on during the previous year. Carried on during the previous year. Profits and gains. The first thing is very simple, straightforward. The heading is given. Okay. Profits and gains of business or profession which I have been doing during the previous year, which I have been, for all of us sitting here, which I have been doing in the financial year 24-25 or assessment year 25-26. Profits and gains of business or profession carried on during the previous year. Am I clear to you? Am I clear to you? Okay, all right. So let me take some time for you to make you understand this. To tax an income under this head, business or profession should be carried on during the previous year. Am I correct? To tax an income under the head PGBP, business or profession should be carried on during the previous year. You all agree with me? Okay, right? PGBP, profits and gains of business or profession, carried on during the previous year. As I told you, the term profession includes vocation also. No, make. I am an advocate and I have been carrying on my profession in the financial year 24-25. The government promotes me as a judge, appoints me as a judge, which means I have to drop my advocacy practice and I have to take over the honorable seat, which I did. All professionals account for on cash basis. All professionals account for on cash basis. So, I also accounted on cash basis. A person who was my client in the financial year 24-25, who was unable to pay his fees in the financial year 24-25, came to me in the financial year 25-26 and paid my fees. It is not taxable in my hands. Is it correct? Because in the financial year 25-26, I am not carrying on business or in the financial year 25-26, I am not carrying on business or profession. When I was doing my business in the financial year 23-24, 24-25, I wrote off a lot of debtors as bad debts. In the financial year 25-26, I have discontinued doing my business. Now my person who I wrote it off as bad debts came and gave me the money. It is not taxable in my hands because I am not doing business or profession in the financial year 24-25. Am I correct? None of these are taxable in my hands. Remember, though I will again talk about it, again I will tell you, remember, this is the birth of section 41. This interpretation is the birth of section 41. Section 41. What did I say to remember? It's a deemed income. It's not direct. In 41, they will say, bad debts recovered, fees recovered, irrespective of the fact whether business or his profession is carried on during the year of recovery. During the year of recovery. Section 41 is going to say when we come to that section. Now I am saying you, even though the word carried on during the previous year is there, it has exceptions. It has exceptions in section 41. In house property chapter, there is also a concept called unrealized rent. That is, the tenant has not paid the rent, so I reduced it from my actual rent. Later, the tenant comes and pays. At that time, I have sold the house property itself, but still it is taxable. Arrears of rent or unrealized rent is taxable, even though the house property is not there. Similar concept, friends. Similar concept. Okay, similar concept that it will be taxable in section 41, which we will see. Okay. The second item, allow me to complete it, then take it down. The second item I am going to talk about is compensation. Compensation received. My dear friends, compensation received is a business income. Why I am stressing upon this point is, normally these type of compensation are one-time receipts and it should go to capital gains chapter. I told you, one-time things always go to capital gains chapter, but that's why this chapter heading itself, they have framed it in such a manner, profits and gains also. Gains also are all taxable in this chapter. Even though it is one time, it is going to be taxable in this. What type of compensation are we speaking about? Breach of contract. Breach of contract. Compensation for breach of contract. Friends, I am supposed to supply to our friend 1 lakh units of a product. Please remember, I am supposed to supply to him 1 lakh units of a product every month. That is his raw material. Using that, he does his production process and he has given his commitment based upon that. Now, in a particular month or in couple of months, I am unable to supply to him. One of the penal clauses in the agreement between us is, where I am unable to supply to him, I have to compensate. I compensate. For me, it is a revenue expenditure. For him, it is an income under PGBP. It is an income under PGBP, my dear friends. For me, it is a revenue expenditure. For him, it is a business income. And not it, since it is a one-time receipt, you cannot call it as. So compensation for breach of contract is a business income. Compensation for breach of contract is a business income. I would have even breached it to the government. In section 37, I will again say you, my customer is government and I pay compensation. Oh, this is penalty. No. Just because it is paid to government, you should not understand it as penalty. For me, it is an expenditure, revenue expenditure. I will tell you in section 37, expenditure. For the receiver, it is business income. Pakka clear? Okay. Okay. Change, four branches it is going to be. Change or modification in agency or managerial agreement. Change or, yeah, please, you can take them remote. Change or modification in agency or managerial agreements. Okay, I go by the same example again. He is my agent. I appointed it as an agent in the area of Chennai. I appointed him as the agent in the area of Chennai. My dear friends, suddenly I have appointed him for a period of 5 years. At the end of the 3rd year, I am terminating the contract or modifying that. No, I am restricting you to South Chennai. He has invested based upon my promise. Change or modification in the agency or managerial agreement. For me, the payer, it is a revenue expenditure. For the receiver, it is business income. It is a business income. Okay, it's a business income. The most controversial, non-compete fees. Non-compete fees, that is not competing, okay, refraining from doing an activity. What is it? Refraining from doing an activity. In some of the questions, we will read this adjustment. A sum of 5 lakhs was received for not starting software business for the next 5 years. The joint venture company, like Maruti Suzuki, TVS also had Suzuki deal, TVS Suzuki. Okay. After the deal, Suzuki cannot directly enter into two-wheeler market. There are terms like that. Okay. So refraining from activity for which a certain sum of money is paid, that is also considered as business income. For the receiver, it is treated as business income. Friends, breach of contract. Okay, I have promised to supply, I have not supplied. Once more repeating, I have promised to supply, I have not supplied. This is known as breach of contract, and it is considered as business income. Once more repeating, breach of contract is a business income. Breach of contract is a business income. I promised to supply plant and machinery within 1 year and complete its installation. I took 1.5 years to complete. Extra 6 months time, for which I am paying him compensation. The law has said, where the compensation relates to a capital asset. Once more, where the compensation relates to an asset, not even capital asset, where the compensation relates to an asset, then it will not be treated as income. It should be adjusted with the cost of the asset. It should be adjusted with the cost of the asset. Repeating, friends, where the compensation paid, no, leave it to me, I'll tell you how to write. Where the compensation paid relates to a capital asset. So from his perspective, I speak. Where the compensation received relates to a cap asset for plant and machinery, for building, etc., then the compensation will not be treated as income. It is an exception to this rule. Normally, breach of contract, it is an income. Okay, it will be treated as, it will be reduced from the cost of the asset. My dear friends, in the 3rd branch, Saurashtra Cements case. Saurashtra Cements Limited. Saurashtra Cements Limited. Okay, Saurashtra Cements Limited. Okay, liquidated damages. Liquidated damages. Liquidated damages. That is compensation. That is compensation. Liquidated damages. That is compensation. Okay, will be adjusted with cost of asset. Okay, will be adjusted with cost of asset. Okay, Saurashtra Cements Limited case, liquidated damages received towards an asset, my dear friends, towards an asset. It should be adjusted with the cost of the asset. It should be adjusted with cost of asset. Am I clear to you? Okay. Normally, all compensations, non-compete fees is also a compensation, will be treated as business income. Only one compensation which will not be treated as business income, that is due to the judgment given by the Supreme Court in Saurashtra Cements Limited, that it will form part of cost of asset. Okay, okay. May I move on? Okay. Third, perquisite or benefit vehicle number 2234, blue color, and 0814. Yeah, can you please change the margin? Okay, perquisite or benefit received. Perquisite or benefit received for carrying on business or profession. Perquisite or benefit received for carrying on business or profession. In fact, in the course of carrying on business of profession, instead of the word right, for in the course of. Perquisite or benefit received in the course of carrying on of business or profession, whether convertible into money or not. Perquisite or benefit, non-monetary things received in the course of carrying on business or profession, whether convertible into money or not. My dear friends, an IT-80 case is won by a chartered accountant. Apart from paying fees, the client also gives the chartered accountant a mobile phone. Taxable under business or profession. Taxable under business or, the fair market value of the mobile phone is taxable under business or profession. Perquisite or benefit received in the course of carrying on business or profession. A patient gift doctor. A patient gift doctor a car. Taxable under business or profession. The fair market value of the car is taxable under business or profession. A doctor receives some gift from a pharmaceutical company. Section 194R is attracted. That we will see later. Okay. But for the doctor, it is considered as business or profession income. My agent completed the target given, because of which I give him a gold coin. The fair market value of the gold coin will be treated as business or profession in his hands. For achieving the target, I am taking my agent to a Bangkok trip. For achieving the target, I am taking the agent to a Bangkok trip. The agent says, boss, I have only two options. Either go for the trip or be at home. So, since I cannot encash it, I went for the trip. And now I know that the company has spent for air tickets, etc., and my stay, everything put together 1 lakh. Why are you taxing me? I don't have another option. I am not coming. Please pay me the money. I don't have that option. Then income tax law thought, oh, I understand. You don't have the option. And we all thought that the Income Tax Act is going to make an amendment which favors the agent. They included the word whether convertible into money or not. Even if you don't have the option, have you gone to the Bangkok trip? Take it as we have. I will do the question also and so. A group air ticket was booked for the agent. Group air ticket. And the cost of ticket of the agent amounted to 25,000. 25,000 should be treated as income. In the act, whether convertible into money or not, it should be treated as income. Am I clear to you? So, perquisite or benefit received in the course of carrying on business or profession is an income. Remuneration and interest or any payment received by a partner from a firm partner's remuneration is not taxable as salary. Partner's interest is not taxable under IFOS. Be it remuneration or interest for a partner, it is always taxable under business or profession. Remuneration and interest or any payment received by a partner from a firm or from an LLP will be taxable as business income. Will be taxable as business income. Export incentives. Export incentive. All type of export incentive or business income. I ask you to remember two things in this. Duty drawback and sale of import entitlement license. I ask you to remember two things. Duty drawback and sale of import entitlement license. Once more repeating. All types of export incentives are business income. All types of export incentive, even it might be one time. What is this? Sir, I exported for 10 crores. My dear friends, I exported for 10 crores, which means I am bringing forex to the country. They gave me one benefit. I can import for 10 lakhs without paying any duty. Without paying any duty, I can import for 10 lakhs. I don't have anything to import. I don't have anything to import. Whereas my friend has something to import. I tell him I will sell my import entitlement license. Pay me some money. Sale of import entitlement license. Very often repeated. Duty drawback is a business income. Sale of import entitlement license is a business income. Am I clear to you? Am I clear to you? Income of any trade or professional association from members. Okay, from members. I did not go anywhere else. ICAI gets membership fees. We all pay membership fees. You all pay students' fees. Okay, we all face. Otherwise, we both are same. Okay, right? So that is a exact for ICAI. It is coming under business or profession. Similarly, many trades configuration of Indian industries. FICCI, like that. There are many organizations, okay, which get money from their members, income from any trade or professional association, which it is earning from its members, okay, is also taxable under business or profession, is also taxable under business or profession. Okay, my dear friends, these are all the most dynamic things in our discussion. You will wonder there are other things like a keyman insurance. I know when to discuss. We know when to discuss. Okay, we know when to discuss. Don't worry about the other things. Yeah, I'll go to the this next item as conversion of stock into asset. Conversion of stock into asset. My dear friends, wherein I have been using it as stock. Vasant and Co, who are dealing in consumer durables, constructs their own office. From their shop, they take 3 air conditioners to their office. From their shop, they take 3 air conditioners and use it in the office. The fair market value, had it been sold to a third party, what value they would have sold, that will become income, or that should be recorded as income. Conversion of stock into asset is treated as income. Okay, right? FMV will be considered as income. Am I clear to you? Okay. In income, in section 28, these things you remember. In income, in section 28, I am loud and clear. Nothing else you need to remember. Only these things, if you remember, you will be able. This is the examination oriented questions. That's what I call it as direct exam. Okay, there's no point in talking about know-how or patent where the right. It is a 14 years back provision. 14 years back, know-how or patent was not an intangible asset as defined in the income tax law. So people were taking it as a expenditure. Later, when you sell the right, etc., those things, even 14 years back, I have not seen them questioned. Even now, I am not seeing being questioned. What about 35 AD? We'll go to 35 AD. Nothing but if you have used an asset for a specified business, later sell it, the asset value will be treated as income. Scientific research, same. We'll see those in those sections. In section 28, you need not go beyond this. Just for confirmation's sake, my dear online friends, I hope you are following. Online friends, if can, yeah, thank you, Jagan, for, okay. So I just want to test the audibility also. Thank you, Jagan. Okay. Can someone, one of you unmute and talk so that I don't know whether the speaker is connected? Can one of you unmute and talk? Yeah, okay. Okay, I'll just check with the speakers during the break. Okay, if at all you have any doubts, you can text me. If at all you have any doubts, you can text me. Whenever I see the mobile, I will definitely answer that doubt. Sir, for this doubt of, sir, will recordings be provided? I think there is a encryption cost which you need to pay for the recordings. Okay, I don't go into commercials. I just take class. Other things, anything with regard to classes and taxes to me, other things, please contact the admin with regard to those aspects. Okay, may I, friends? May I? So these are all that. Now, as a supplementary thing, okay, I want to also touch upon some of the areas, mainly ICDS 9 on government grants, on subsidy, how the accounting has to be. Before progressing to section 29, let us complete some of the aspects. Subsidy, that is government grants. Though I assure you to take ICDS also. Okay, subsidy or government grants, how it is being dealt with. For what purpose you got the grant makes that difference. If it is for depreciable assets, if it is for depreciable asset, okay, then adjust it with the cost of asset. If the subsidy is for a depreciable asset, my dear friends, the subsidy received should be adjusted with the cost of the asset. The subsidy received should be adjusted with the cost of the asset. If it is for non-depreciable asset, mainly we are speaking about land. Or if it is a general subsidy. What is a general subsidy? Sir, if you start industry in a backward area, you will get a subsidy. It is not towards an asset. It is for starting a business in the backward area, northeast part of the country. Okay. In these cases, the law says it should be treated as income. It should be treated as income. Subsidy received towards a depreciable asset should be, though it is not part of section 28. I am moving out of 28. But it relates to income. Okay, if it is towards a depreciable asset, adjust it with the cost of the asset, reduce the asset value. If it is for a non-depreciable asset, mainly they are speaking about land. Or if the subsidy is a general subsidy, consider it as income. Am I clear? Okay. I am moving into case laws pertaining to income, section 28. Okay, that section case law, then and there we will complete and then understand it. Okay, section 28. Okay, case laws on section 28. Case laws on section 28. Okay, basically there are, I divide it broadly as three. PGBP versus IHP, income from house property. Okay, PGBP versus capital gains. PGBP versus IFOS. Under which head it gets taxable? Okay, am I clear to you? In this, Chennai Properties and Investments Limited. In this, Chennai Properties and Investments Limited. Friends, Chennai Properties versus Investments Limited. You let out your house property. It is taxable under house property. Oyo Homes. How do you determine that? They are also letting out house property, service apartments, commercial purpose. The law, how do you say it is commercial purpose? This is where the Supreme Court's judgment becomes important. Supreme Court said two factors has to be considered. The main object of the organization should be letting out. The main object of the company or the organization, firm or whatever it is, should be letting out. That is easy. Anything can be put in the main object. Then all of us will put. The primary source of revenue should be from this. In the P&L account, on the credit side, if you have a total income of 1 crore, at least 51 lakhs should be from letting out of properties. If these two conditions are satisfied, then I will call it as commercial let out. That's the word you have to remember, which I thought I should say loud. Now I am very clear you are remembering that. It is known as commercial let out, and it will become there. Am I clear to you? Am I clear to you? Okay, right. So Chennai Properties and Investments, two conditions to tax as commercial property. Two conditions to tax as commercial property. Okay, condition number 1, main object. Condition number 2, main substantial source of income. Substantial source of income. Am I clear to you? Okay. Am I clear to you? Chennai Properties and Investments Limited. Okay. Under that, please write whatever I am saying. Raj Tadkar. R-A-J. Raj Tadkar. Sorry, Raj Tadkar. Same case laws, my dear friends. Rayala Corporation. Same. Raj Tadkar. Rayala Corporation. Please write under this the names of the organization. Okay. All these things same. All these case laws same. Okay. New Delhi Hotels. NDR Warehousing. New Delhi Hotels, NDR Warehousing. Same. Okay. In NDR Warehousing, all the more they said, not only warehousing facility, but they are also doing a lot of maintenance activities. So it should be treated. The simple thing is, it is not house property. Why argument? Assessing officer will always tax it under house property because only one deduction can be claimed. Standard deduction 30%. If at all interest on borrowal is there, it can be claimed. Whereas business, I have a watchman, I have a lot of employees employed, I run an office. Do you find the difference? So that's why there is a conflict. Okay, right. The Gujarat state government, my dear friends, announced a fertilizer subsidy. The Gujarat state government announced a fertilizer subsidy. Okay. That is for manufacture of fertilizers. They have to supply it at a reduced cost. So they announced a fertilizer subsidy. They are unable to give the subsidy. They are unable to provide the subsidy. So they compensated the subsidy. They compensated the subsidy in the form of money. They compensated in the form of a license. Sorry. In the form of a license. So I am supposed to receive 5 lakhs as subsidy. I got 5 lakhs worth of license. I sold that license to him as 3 lakhs. I sold the license to him at 3 lakhs and said 2 lakhs business loss. Am I correct? The department contended that what you have sold is only a license. So it should be taken as short-term capital loss or long-term capital loss and not as PGBP. Who is correct? Assessee. Why? License is given in lieu of subsidy. Had subsidy been given, it will be treated as income because subsidy towards non-depreciable asset and general subsidy will be treated as income. When subsidy, if subsidy is provided, it is treated as income. Subsidy is provided in the form of license. Any loss or profit will only be treated as business income. Gujarat Chemicals and Fertilizers Limited. Gujarat state. Fertilizers and Chemicals Limited. Gujarat State Fertilizers and Chemicals Limited. Sale of license which is provided in lieu of means instead of, in lieu of subsidy will be business income or loss. Will only be treated as business income or loss because if you have received it as subsidy, you would have treated it so. Am I clear to you? Am I clear to you? Okay, friends. In this, the important one is K and Co. In this, the important one is K and Co. What is this case law? Interesting. Interest on deposit. My dear friends, interest on deposit. Please listen. Interest on deposit is normally taxable under other sources. Now, I have made a deposit. Listen, I have made a deposit because I need to obtain a bank guarantee. Law splits deposit into two now. Is the deposit out of surplus funds? The interest is taxable under other sources. If the deposit is for obtaining a bank guarantee, without giving bank guarantee, I cannot run the business. Without giving, I would not get that business. This interest is associated with your business, so it should be treated as business income. This interest is associated with your business, so it should be treated as your business income. Okay? Interest on margin money deposit. Interest on margin money deposit for obtaining bank guarantee is business income. Interest on margin money deposit for obtaining bank guarantee is business income. Is business income. What are all the rules of share application money? It should be kept deposited in a separate bank account. You cannot use it till allotment. Is it your option to keep it deposited in a separate bank account? It is mandated. It is mandated. So that interest is available for setting off share issue expenses. Sri Rama Multitech. Sri Rama Multitech. Sri Rama Multitech. Okay. Interest on share money, share application money. Interest on share application money. Interest on share application money is available for setting off share issue expenses. Is available for setting off share issue expenses. Am I clear? Okay. This is section 28 along with the subsidy ICDS along with the relevant case laws. How to answer this case laws, I will tell you what words are keywords. But these are all the things. Just quickly go through these. Shall we? Shall we, friends? Shall we move on? Yeah. To your practical material. To your practical material. This is where I am going to tell you how to answer this in the examination. This is where I am going to tell you how to answer it in the examination. If you don't have the practical material, no issues. You can see it on the screen, okay, and answer it. Some questions you need to keep it in your mobile. These questions you can. Specify the treatment of following while computing income under PGBP. Subsidy received as general contribution, okay, according to ICDS, any general subsidy shall be treated as business income. So the words ICDS and the word ICDS and the word general subsidy is more than sufficient. Okay. Subsidy received. No, you are writing along with me. Yeah, please put it as case A and write. Okay. Subsidy received for construction of hospital building. What happens? What happens? Subsidy received for construction of hospital building. Is building a depreciable asset? Yes. Okay. According to ICDS, any subsidy towards a depreciable asset, the same should be adjusted from the cost of the asset. The same should be adjusted from the cost of the asset. Compensation received for breach of contract. According to section 28. If you don't remember the section number, I'm fine with it. According to section 28, to be treated as business income. To be treated as business income. Compensation received for failure. Compensation received for failure to supply plant and machinery on time. Compensation received for failure to supply plant and machinery on time. Okay, according to, okay, Saurashtra Cements Limited judgment, it should be adjusted with the cost of plant and machinery. It should be adjusted with cost of plant and machinery. Are you understanding? Are you understanding? Okay, compensation received for failure to supply. Remember Saurashtra Cements Limited. I want you to just highlight that case law in the examination. In the examination, okay, Saurashtra Cements Limited. So, or if go to the core principle of, if it is received towards the capital asset, if it is received towards an asset, it should be adjusted with the cost of the asset. Non-compete fees. To be treated as business income. To be treated as business income. Okay. Now I am saying something which, if it is a standalone question, you write it. Very rare. I haven't seen, but there is an interpretation. However, there is a school of thought which specifies that if it is non-compete fees for profession, then it is taxable under capital gains. Non-compete fees for business is definitely business income. There is a school of thought which says if it is non-compete fees, software makers, like that, if it is non-compete fees for the purpose of profession, it will be taxable under capital gains. But it's just a school of thought, not anyway arrived at decision. Sale of import entitlement license according to section 28. According to section 28, any export incentive shall be treated as business income. Sale value of import entitlement license will also be is also considered as export incentive taxed under this chapter. Payment received by a partner from a firm. According to section 28, any payment which is allowed as deduction in the hands of the firm will be taxable in the hands of the partners under business or profession. Okay, if it is allowed in the hands of the firm, if it is allowed in the hands of the firm, then it is taxable in the hands of the partners. Okay, about this again I will talk. 40B is the section, remuneration and interest to partners. We will speak about that. Just giving you brief ideas. Travel expenses incurred by the principal company for achieving target. According to section 28, any perquisite or benefit, whether convertible into money or not, shall be treated as business income in the hands of the receiver. In the given case, in the hands of the agent, the travel expenses will be business income. Take your time. If I am fast, you can stop me. Liquidated damages received by a company from the supplier. Okay, the same, it got repeated. Fortunately, from yesterday, my control key is not working. See, okay. interest received on excess application money deposited in the bank. Okay. Any issue expenses can be adjusted against that income. Any issue expenses can be adjusted against that income. Am I clear? Am I clear? Okay. Yeah. Okay. So, popularly in income, remember sale of import entitlement license, remember Saurashtra elements, and remember perquisite or benefit. These can be one of the adjustments in our questions. We will keep answering. I told you till the last class, I'll keep answering these things. Okay. So this is section 28 and its related case laws. You want time? You want time? Sure. Okay, right. Moving on to section 29. Moving on to section 29. Mode of computation. Section 29. Mode of computation. Taxable business income is revenue, that is whatever we studied in section 28 and whatever we are going to study under 41, minus allowable expenses. Okay, and the stress is on this word, allowable expenses. Taxable business income is equal to income, that is revenue, minus allowable expenses. The stress is on the word allowable. It's not expense. Accountancy, income minus expenses. Here We have one word which makes all the difference. Allowable expenses. This term allowable expenses is divided into three. Expressly allowed by law. Expressly allowed by law. Okay, section 30 to 37. Law says, boss, you can claim it. Expressly allowed by law, section 30 to 37, where law says, yes, these expenses are allowed. Expressly disallowed by law. Expressly disallowed by law. 40 and 40A. Section 40 and 40A expressly disallowed. Law says, boss, you cannot claim it as deduction. Allowed only on the basis of payment. Allowed only on the basis of payment. 43B. My dear friends, expressly allowed by law, 30 to 37. Expressly disallowed by law, 40 and 48. Allowed only if you make the payment, 43B. Okay, only on cash basis, not technically cash basis, pay within the due date, but only on the basis of payment. Okay, the entire stress is on the word allowable expenses, and the allowable expenses is divided into these three. Okay, right? With this, I walk into the first part, which is expressly allowed by law. Okay, that is section 30 to 37. Okay, right? I am, my understanding of income tax law goes like this. 30 to 37 is divided further as expenses, not to write, just understand. Expenses on asset is 30, 31, 32. In that 32 is bigger, that is different, but it is on based of asset. Deposit based deductions are section 33. Deposit based deductions are section 33. Friends, I'll tell you, every law has a has logics which is beyond. We need to some time to understand it. If the lawmaker, understand my explanation, if the lawmaker want to give the deduction as a percentage of asset, they will make it fall under 32. Depreciation. Previously, there was something known as investment allowance, 10% of the asset value, 25% of the asset. If the lawmaker want to give the asset itself as deduction, they will make it fall under 35. 35 is a promotional section. Specified business, scientific research, skill development, agricultural development program. It promotes, motivates. Okay. So the logic you have to understand is, if it is percentage based, 32. If assets itself can be allowed, 100% of the expenditure allowed, capital expenditure allowed, be sure it will fall under 35. That's the intention of that section 35 itself. So motivational or promotional sections, though I'm not restricting, okay, is section 35. Others is under section 36. General is under section 37. This is how 30 to 37 is divided. Okay. This is how 30 to 37. I tell you, there is nothing to remember in 30 and 31. You will automatically allow it. Two things, be very sure. I will not give you false confidence. My intention is not that. My intention is to tell you that we are focusing wrongly. You always think that in this we have to focus on 32, 35, 37 primarily, and 36 is important. Our primary focus is that. We should not lose focus. That's why I am making it. That's my intention. Not to give you false confidence, but to make you focus on these are all the areas you need to work. Okay. So I will start with asset-based deduction. Okay. I will start with asset-based expenditure. And first I will only cover the two sections. Section 30, Section 31. Section 30 is with regard to, okay, building. Section 31 is with regard to plant, machinery, furniture. Plant, machinery, furniture. Okay, friends? Okay. For building, what are all expenses I can claim? If I am taking the building on lease and working, rent can be claimed. Here we call it as hire charges. Rent can be claimed or hire charges can be claimed. Okay. Repairs and maintenance. Incidentally, we call it as current repairs, which means recurring repairs, not one-time repairs. Same, you can claim repairs and maintenance. Okay. Insurance, you can claim. Taxes, there is nothing for that as of now in our country. Hope the classroom is not heard by the finance ministry. Oh, there is no taxes for plant machinery. Okay, here municipal taxes are there, which can be claimed. There is no as such taxes are there. Okay, so these are all the expenses you can claim. Why should we have a section for this? Two sections. Okay, rent, current repairs, maintenance, insurance, taxes are allowed as deduction for building. Hire charges, current repairs and maintenance, insurances are allowed as deduction for plant, machinery and furniture. Yeah, you want any explanation, friend? You're clear? You're clear? All of you are clear, right? Okay. Online students, are you following? Are you following online students? Okay.
But when the taxes being GST is claimed, so here the tax is not.
So input credit always claimed, nothing is allowed. Here I am not I am meaning municipal taxes. Municipal taxes, not GST. There is no municipal taxes as such here. There is no municipal taxes as such here. Okay. Municipal taxes are not there. That's all. But actually, GST is a separate area. We'll discuss that. May I move on to section 32? Section 32, depreciation. Section 32, depreciation. Section 32, depreciation. The same accountancy level of explanation only. Reduction in the value of asset due to usage. change in technology, and lapse of time. Wear and tear, obsolescence, lapse of time, effluxion of time. That is the same explanation for depreciation, and accountancy and income tax similarity stops there. After that, income tax law says, I'll take care. You leave it to me. Okay, like தலைவர், my way is a separate way. Okay, right? So from there, income tax law entirely differs with regard to depreciation, explanation, computation, etc. Okay, that's why we always disallow book depreciation and compute income tax law depreciation separately. There are 4 conditions for claiming depreciation under income tax law. There are 4 conditions for claiming depreciation. Friends, condition number 1, it should be a specified asset. Condition number 1, it should be a specified asset. In income tax law, to claim depreciation, it should be a specified asset. What is a specified asset? Building, plant, machinery, furniture fixtures, intangibles. It should be a specified asset. What is a specified asset? Building, plant, machinery, furniture fixtures, intangible. Okay. I will write a few more explanation. This is the format in which we are writing also. Put it as branch so that catch memory. When we see it, we will understand it. Okay. Land and goodwill are not specified assets. Friends, 2 assets for which I cannot claim depreciation. Land and intangible explanation, the word goodwill is not there. Know-how, patent, trademark, copyright, any business or commercial right is what is intangible. Goodwill is specifically excluded, and 5 years back the Finance Act itself said goodwill is not a, okay, because everybody says their goodwill is very high. Okay, so goodwill is not, cannot be valued, will not be valued. Even purchased goodwill in your amalgamation will not be considered for depreciation under income tax law by the okay, right? So goodwill is not a, land and goodwill is not a specified asset. Now that leads us to the explanation of what is plant, and remember the explanation is in section 43. That's why I say 43 is a support section. When we wrote also, I wrote 43 gives lot of support, lot of section 43 says what is meant by, okay, plant. Okay, and we thought that they are going to define plant. They gave a list. Okay, they did not define plant. They gave a list, and the list made us to believe that it is better not okay, because what is plant? Plant includes vehicles. We don't know how. Vehicles are plant. When I say vehicles, aircraft is a plant. You look, okay, yeah, seems to be correct, sir. Cycle is a plant. Okay. After vehicle, they have written this. Air going, ocean going, land going. So cars are plant, ships are plant, aircraft is a plant, 2-wheelers are also plant. Data processing equipment, computer. Computer is a plant. Computer is a plant. Electronic items. Electronic items. Then comes the biggest aspect. Electrical items. Electrical items. Okay. This laptop is a plant. Okay. If not to a larger extent, at least to a smaller extent, I will accept that it will manufacture knowledge. Okay. That projector is a plant. This camera is a plant. That itself, we have a small pain in our plant. This tube light is a plant. You'll feel like breaking it. But that is the truth. Fans, electrical fittings, lights are all plant. Surgical equipment. And scientific apparatus. Sorry, also books. Also books. Okay, everything is a plant. So whatever is not a furniture, whatever is not intangible, whatever is not building will fall under plant. And then we all it also started pricking to many of the lawmakers, etc. Nowadays we never use the term plant. Plant and machinery. Plant and machinery. Why should we segregate? Okay, so not an issue. So it should be a specified asset. What is remembering the classroom is two things are not specified asset: land, goodwill. Used for the purpose of business. Used for the purpose of business. Used for the purpose of business. To claim the depreciation, primary condition is it should be used for the purpose of business. Or when I say business, I also means profession and vocation. It should be used for the purpose of business. This usage is further divided into active and passive. It can be active usage, passive usage. I'll explain. I have a machine using which I am producing goods. Can I claim depreciation for that? Yes. Can I claim? Yes. You all agree with me. I have a spare machine ready. If my main machine goes out of order, I am going to use my spare machine. Can I claim my main machine was running well last year, throughout the last year? Can I still claim depreciation? Yes. Passive, ready to use. I have power. I have a power backup for 24 hours or 48 hours. Apart from that, I have a generator. Last year, I never had a power cut more than 48 hours, so I never used my generator. Does that mean that I cannot claim depreciation for my generator? No, I can still claim because it is ready to use. Okay, use. Okay, both qualify. Okay, ready to use is equal to put to use. Okay, remember, ready to use is as equal to put to use. It means that we have put to use. Am I clear to you? Okay. Owned by assessee. The last is block of asset. First, asset should be owned by assessee. Only owner can claim depreciation. Only owner can claim depreciation. Only owner can claim depreciation. Are you clear? Only owner can claim depreciation, friends. Firm is not recognized by many laws. Companies Act says shares cannot be held by a firm. It can be held by partners in their individual name, joint names. Motor vehicle law says a firm cannot buy motor vehicle. It should be registered with a natural human being name. Hindu undivided family cannot buy an asset. It can only buy in the name of the Karta, and then HUF can use it. Now, I am a firm, but the deed or the vehicle registration is not in my name. What should I do? I cannot claim depreciation. I cannot claim. No, I can claim. So came a concept called beneficial owner can claim. Who is a beneficial owner? One who invests and uses is known as a beneficial owner. One who invests and uses is known as a beneficial owner, and they can claim the benefit of depreciation. Am I clear to you? Am I clear to you? Okay, friends. For these two things, I am now going to tell you. For these two things, I am going to tell you. A. Sivakami and Co. A. Sivakami and Co. Okay. HUF being the beneficial owner, HUF being the beneficial owner can claim depreciation. HUF being the, okay, they are running cabs, my dear friends. They are running cabs. Okay. The income tax officer disallowed depreciation because cabs are not registered in the name of a HUF. Court asked, where is the income recorded in the books of the HUF? Who funded the car? HUF. Registration is just a formality, substance over form. In substance, it is owned by the HUF, beneficial owner. ICDS Limited. ICDS Limited. ICDS Limited. Friends. I am a lessor. He is a lessee. I fund his lorries or vehicles. In order to avoid two registration charges, what I did is I registered directly in his name with a clause where he is not making lease payments. I can repossess it and register in my name. Okay, repossession clause is there. The assessing officer said two things. The name in the invoices or in the legal documents is that of the lessee. The lessee only uses it for his business. So lessee can only claim depreciation, not lessor. AO said legally lessee is the owner. I mean, legal document wise lessee is the owner, and usage is also only by the lessee. So depreciation can only be claimed by the lessee and not the lessor. The court said, in order to avoid two registration only, it is named registered in the name of the lessee to avoid dual registration charges. And there is a specific clause which says I can go and repossess. If it is his asset, without his consent, I cannot. But there is a specific clause I can go and repossess. Who said lessee is using the asset? It is lessor who is using the asset because his business is making others use it. What is my business? If I buy an asset and use it for me, I am not a lessor. I am funding an asset which is used by my lessee. So my business itself is making the other to use the asset. Making the other to use the asset. So the law said, boss, both the conditions are fulfilled. I understand there are two conditions. Condition number one, it should be used, the owner, the true owner, beneficial owner is lessor. And usage is also by the lessor and not lessee. Fourth concept, block of asset. Assets of similar nature will be grouped and depreciation will be on group balance. One minute, I'll check, friends. 1 minute, I'll check. For those who missed the block of asset condition, I'm repeating. Assets of similar nature. Assets of similar nature in block of asset. The fourth condition is block of asset. The fourth condition is block of asset. Assets of similar nature having same rate of depreciation will be grouped and depreciation will be claimed on group balance. Assets of similar nature having same rate of depreciation will be grouped and depreciation will be claimed on group balance. Will be claimed on group balance. That is the condition. So, friends, if I have 15 cars, all the 15 put together, because company law or accountancy, general accountancy says car 1, car 2, car 3. Imagine TCS or Infosys, 1 lakh computers minimum. Remember our institute, we have how many chairs? We are unable to even number intent. Income tax law gave us a big relief by saying, boss, group it. Claim depreciation on the group balance, not on individual assets, but on the group balance. There are 4 conditions for claiming depreciation, my dear friends. Okay, it should be a specified asset. What is not a specified asset? Land and goodwill. It should be used for the purpose of business. Usage means active as well as passive. Owned by the assessee. Ownership include beneficial ownership. And block of asset. 2 case laws we have seen. A. Sivakami and ICDS Limited. Am I clear to you? Okay. Format for computing depreciation. Since our financial year is 24-25, I am writing it, or you can write it as opening balance alone. Etc. These things by today. Opening WDB, additions divided into two, 180 days or more. Put to use is the date which is important, not the purchase date. If it is a plug and play date asset, then they will not give you put to use, they give you the purchase. If they give the purchase date, take the purchase date. If they give both purchase date and put to use date, only put to use date is relevant. Put to use for 180 days or more, or less than 180 days. Okay. Less sale value. Balance available for depreciation. This is one important aspect of our computation, because on this balance only we are going to compute depreciation. On this balance only we are going to compute depreciation. Why are we dividing asset into 180 days or more and less than 180 days? Okay. Reason for dividing purchases as 180 days or more slash less than 180 days. Okay. Now, for a minute, please understand. I reverse compute and show you. March, from March I'll come. Reverse. Feb, Jan, December, November. 151 days. 179 minus 151 makes it 28 days. October has 31 days. Okay, so when I say put to use for 180 days or more, I technically mean on or before 3rd October. Okay, though for practical purposes we will take 30th September. Okay, suppose in an exam question they have put 1st October, take more than 180. Take it as more than 180. Rare only, but I'm just preparing you. Okay, where an asset has been purchased and put to use for 180 days or more. Okay, 100% of eligible depreciation can be claimed. If it is 15%, 15%. If it is 20%, 20%. If it is 10%, 10%. 100% of the eligible depreciation can be claimed. Where an asset is purchased and put to use for less than 180 days, okay, 50% of eligible depreciation can only be claimed. 50% of eligible depreciation can only be claimed. This is much different from our accountancy concepts. Or suppose in accountancy I purchased an asset and put to use on 1st of July. Asset value into rate into 9 by 12. 1st August 8 by 12. 1st January 3 by 12. But income tax law says, boss, first half, second half. If you purchase an asset and put to use in the first half, claim full depreciation. 100% of eligible depreciation can be claimed. If you put to use in the second half, claim half of the eligible depreciation. Even if I put to use on 31st March, accountancy says asset value into rate into 1 by 365. Income tax law says 50% of the eligible depreciation can be claimed. If it is 15%, 7.5%. What do you mean by put to use? Ready to use is also put to use. Passive assets can also be claimed for depreciation. Am I clear to you? Okay. Yeah, sure. May I? May I? Okay. Now, I am progressing to the next level. The whole of the sale value should be reduced from the block. The whole of the sale value should be. Please understand, in accountancy, there is a concept of profit on sale of asset, loss on sale of asset. There is no such concept here. The whole of the sale value should be reduced from the block. Am I clear? Okay. On sale, there is no depreciation. Not only for your academical purposes, but also for your practical purposes. Understand something. Depreciation is a 31st March concept according to income tax law. Repeating, under income tax law, depreciation is a 31st March concept. On no other date you can claim depreciation. On no other date. This is not accountancy up to the date of sale. On no other date you can claim depreciation under income tax law. Depreciation is a 31st March concept. 31st March night, whatever assets are there with you, on that assets you can claim depreciation. Even if you have sold some asset on 31st morning, no depreciation for them. Under income tax law, depreciation is a 31st March concept. Is the class clear? Is the class clear? So this is something which is because this doubt you will very often arise for you. What is it? Have it in your mind. Depreciation can never be claimed on any other date other than 31st March. Okay, right? Depreciation is at the rates prescribed by law. Depreciation is at the rates prescribed by law. As the class goes by, you will understand this. I assure you that you will understand that you need not take special effort to memorize this. As the class goes by, you will understand that. But we are writing once. Building. So buses, lorries, cabs 30%. Otherwise, motor cars are 15%. Am I clear? Computers and accessories 40%. You should leave a line. Leave a line and write. After computers and accessories, leave a line. After computers and accessories, leave a line. For intangibles, 25%. Shall I, friends? Which is the intangible asset which will not have depreciation? Goodwill. All of us clear? Okay, right. These are all the popular rates. You will slowly start remembering. That's my assurity, because we are going to do so many questions. What is the rate for printer? Why? Accessory. What is the rate for scanner? What is the rate for mobile phone? Why? It is not an accessory. Very good. Very good. An accessory or peripheral is one which is dependent on main aspect, without which it cannot perform. Remember, nowadays from mobile you can give print, but it was written, law was written long back. Okay. What is an accessory or a peripheral? Okay. This is why I asked you to leave a line. In Federal Express case, it was held printer and scanner are accessories for which rate of depreciation of main aspect can be adopted. In BSES Yamuna Motors case, it is held mobile phones and EPABX. Okay, I'm dictating, I'll make it right. In BSES Yamuna Motors case, it is held mobile phone and EPABX system. Both are struck. I don't know why. I'm setting it right, friends. Online friends, I'm setting it right. In BSES mobile phones, it was held mobile phones and EPABX system. Okay. Can perform task independently. Hence, only general rate 15% is applicable. Am I clear? Only general rate, that is 15%, is applicable. Okay, all right. Okay. We are moving on, and I'm going into a concept called when does a block cease to exist? That is, goes out of existence. What is the circumstance in which a block is not going to be there? Okay. Ceasing to exist. Block ceasing to exist. That is the circumstance in which a block is not going to be there. When does a block cease to exist? It happens in two circumstances, my dear friends. When all the assets in the block are sold. When all the assets in the block are sold. When sale value exceeds balance available. A block ceases to exist in two circumstances. When all the assets in the block are sold, or when the sale value exceeds whatever is there in the balance. A block ceases to exist in two circumstances: when all the assets in the block are sold, or when the sale value exceeds balance available in the block. When all the assets in the block are sold, or when the sale value exceeds the balance available in the block. In both the cases, the result will be either STCG or STCL, short-term capital gain or short-term capital loss. We call it as block goes out of existence. Block ceases to exist. Is the class clear? Is the class clear? Okay. All right. So once more, my dear friends, opening WDV is nothing but last year's closing WDV. Last year's closing WDV becomes current year's opening WDV. Additions I am dividing into two because where I purchase and put the asset into use for 180 days or more, I am eligible to claim whole of the depreciation, 100% of the depreciation. Where I am using it for less than 180 days, I am eligible to claim only half of the eligible depreciation. From that, I reduce whatever is the sale value. I get balance available for depreciation, less depreciation at the rates. I'm yet to talk about additional I'm yet to talk about addition also. I'm yet to talk about additional depreciation also. Am I clear? Am I clear? Right? Let's do a practical question. For those of you who are having a material in hand, it will be page number 4 because the cover page is not numbered here. For others who are referring online, you can refer this question online also. I mean, in the screen also, you do not take the assessee is carrying on the business of plying commercial vehicle, gives you the particulars of his assets, compute depreciation. Motor car used in the business of running them on hire, 26,50,000 opening WDV. Motor car which is used in relation to business. So my dear friends, used in the business of running them on hire is 30%. Used in relation to business is 15%. Is 15%. During the year, two motor cars were purchased, one in August, another in Feb, one in the first half, second half. First car is for running them on hire, second car is for office use. One motor car used for running them on hire is sold for 56,000 on 11th January. I don't require the date at all. I just require the value for sale. Read through. I'm going to work out that first.
Sir, put to use, ready to use எல்லாமே ஒண்ணுதான் actually.
சொல்றேன் sir. We'll discuss about that. Both are same, sir. For your straightforward question, the answer is yes, sir. They are same.
Thank you, sir.
The assessee is carrying on the business of plying commercial vehicles. He gives you the following particulars of his asset: compute depreciation. Motor car used in the business of running them on hire, 30%, my dear friends. 30%. Tomorrow I'll give you the rate. Motor car which is used in general business, 15%. These are all the two rates for motor car. If I am using it for the running of on hire, 30%. Motor car which is used in the business of relation to business, 15%. During the year, two cars were purchased, 24th August and 16th Feb. First car was used for running them on hire and second one is general office. One motor car of running them on hire was sold for 56,000. Never even see the date. It is irrelevant for us. It is irrelevant for us. Read the question. May I, my dear friends, this is this into 30% because the asset was purchased in the first half. The asset was purchased in the first half. So directly 36 lakh 44,000 into 30%. 36 lakh 44,000 into 30%. Whatever is that, always for sale, no depreciation. So directly this is 30%. Look at this. Look at this, my dear friends. This 7,80,000, I can only claim 7.5%. Once more, I am repeating. On this 7,80,000, I can claim only 7.5%. On the balance, that is 2020 minus 7,80,000, I can claim 15%. Repeating, in this case 12,40,000 into 15%, but if there is a sale, this is the better method. Asset purchased in the second half into half of the eligible rate. Asset purchased in the second half 7,80,000 into half of the eligible rate. Eligible rate is 15%. Half of that is 7.5% plus 2020 minus 780 into 15%. Is the class understanding? Is the class understanding? Okay. The total depreciation is this plus this. Akka clear class? Okay. This is how we compute the eligible depreciation. Okay. Okay. I am moving on. Question number 2. Assessee gives the following particulars of his asset: plant and machinery, motor car, furniture, books, computer. Assessee shifted office, hence purchased the following: furniture first half, second half; computers second half; motor car 1st October, so first half; generator 15%, not at all used in the new office as they had power backup, still they can claim. Put to, our friend was saying no, ready to use is put to use. Majority of the assets are plug and play asset, so ready to use is a assessee shifted the office, hence sold the following asset pertaining to the old office: furniture, all the books available with the assessee. Friends, don't worry about books for some time. Leave books alone to me. For other assets, start doing. For other assets, start doing. Please don't worry about books. Books I will do. For other assets, start doing. Online friends, for some time I'm stopping the viewing. I want you to do it and then show me the answer. This is the answer for the first three assets, that is plant and machinery, car, furniture. Is this you're getting it? Online students, are you getting this?
Yes, sir.
Yes, sir.
This is for computer and generator. So generator type of assets are ready to use, means put to use. Generator, if it is ready to use, it is put to use, because the term put to use is passive. I didn't have any power failure, or my power backup did not go up, then only I will go for generator. When it is normal, I don't go for generator, but that doesn't mean generator will not be eligible for depreciation. My dear friends, under income tax law, remember this. Under income tax law, when block exist, yeah, some question was there, you can ask me. Somebody unmuted. If you have a question, you can ask me. When does a block goes out of existence? Okay. In two circumstances, the block goes out of existence. When all assets in the block are sold. When all the assets in the block are sold, the block is gone. when sale value exceeds balance available. Suppose in this case, I have sold an old asset. Okay, here I have sold this old asset. Let us take for 1,20,000. Not here. Let's keep it here. I have sold it for some 7 lakhs. When all the assets in the block are sold, or when the sale value exceeds the balance available. In both the cases, it goes to section 50, which means next chapter. Yeah, capital gains. The law says it is STCG or STCL. The resulting is for depreciable assets. We will only get STCG or STCL. A block goes out of existence in 2 circumstances. When all the assets in the block are sold, or when the sale value exceeds balance available in the block. In both the cases, the result goes to the next chapter, that is short-term capital gain or short-term capital loss. In this question, they say all the books available with the assessee are sold. All the books available with the assessee are sold. So for books, I will get a short-term capital loss. And block, so please write it like this. And block cease to exist if all the assets are sold or if the sale value exceeds. Okay. Please write and keep. You can just write it. We will again meet tomorrow morning, 6 o'clock, to continue and understand depreciation threadbare. By tomorrow, you should be strong in depreciation. Online students and here students here, meet you tomorrow morning, 6 a.m. All the best. Namaste, good morning, and Ganesh Chaturthi wishes. Friends, let the Lord help us to clear straight away with maximum mark in DT. Okay. Yesterday in the class, we were just looking into a format of computing depreciation. We were looking into the format of computing depreciation. We said we will come each and every line item separately. I start with this. Last year's closing WDV is current year's opening WDV, friends. Opening WDV on 1st April 24. Opening WDV on 1st April 24 is nothing but last year's closing WDV. 31st March 24's closing WDV is 1st April 24's opening WDV. Similarly, if I say that 31st March 25, it becomes the opening WDV of 1st April 25. So the first line item is very simple. Last year's closing WDV is current year's opening WDV. Is the class clear? Is the class clear? Now I am coming to what is meant by additions. What is meant by additions? In our notebook, we start writing concept of addition. Concept of addition. Concept of addition. Okay. By this I mean what are all we are going to include in the cost of addition. What are all we are going to include in cost of addition. Okay. Let's start writing particulars amount. Particulars and an amount column. Particulars amount. Purchase price of the asset. Purchase price of the asset. The amount column just XXX. Purchase price of the asset. Add installation charges. Installation charges. Next line. Freight and other direct expenses. Traveling expenses. Traveling expenses incurred for acquisition of asset. Traveling expenses incurred for acquisition of asset. Traveling expenses incurred for purchase of asset, that is acquisition of asset, which can be acquisition, inspection, anything. Okay. Next, all expenses incurred before putting the asset into use. All expenses incurred before putting the asset into use. All expenses incurred before putting the asset into use. Am I clear to you, friends? All the expenses that I incur before putting the asset into use should be capitalized. All the expenses we are incurring before putting the asset into use should be capitalized. Cost of trial run. Next item. Cost of trial run. Cost of trial run. Next, borrowing cost till the asset is put into use. Borrowing cost till the asset is put into use. My dear friends, let us take some interest is there. Let us take some interest is there. Please understand. Let us take some interest is there for purchase on a loan taken. Okay, loan taken for acquisition of asset. Okay, I split the interest into two. Okay, before putting the asset into use. Okay, before putting the asset into use. Okay, after. Okay, this should be added to the cost of the asset. This is an expenses. This is an expenses. Borrowing cost till the asset is put to use. All borrowing cost till the asset is put to use should be capitalized. Should be capitalized. Am I clear to you? Okay, right. Now I want you to understand an important concept. I want you to understand an important concept. Okay. which is very much different from accounting practices, etc. Suppose I import a machinery. Suppose I import a machinery. What happens is like this. First, listen for some time. Our accountancy says asset account debit to creditors for asset. Okay. Whatever is prevailing on the transaction day. Whatever is prevailing, exchange rate prevailing on the transaction date. Is that correct? Whatever is the exchange rate prevailing on the transaction date, we capitalized. At the end of the year end, okay, that is 31st March, I make an entry for restatement of asset. I make an entry for restatement of the value of the asset. Suppose I imported when it is 60 rupees, when it is 60 rupees per dollar, and now it is 65 rupees. On 31st March, if it is 65 rupees, I debit P&L account and credit creditors for asset. Is this correct? This is what you do in your accountancy, right? This is what you do in your accountancy. And when payment is made, again creditors for asset, okay, creditors for asset, P&L account to okay, bank. That is how you pass the entries in the case of import of an asset in accountancy. In accountancy, now under income tax law, we are not going to follow these things. We are not going to follow these things. We have a separate section for this. We have a separate section for this, which also becomes an ICDS later. Section 43A. Section 43A. Listen to what is 43A telling us. Record first on transaction day at transaction value. So the first entry is the same. On the date of import, whatever is the transaction value prevailing, whatever is the rate prevailing on that day, record the value of asset. There is nothing called restatement at the end of the year and all. There is nothing called restatement at the end of the year and all. Is the class clear? I don't have a concept called restatement. Then what do I have? Okay. On the date of payment, difference between amount paid minus transaction value, which is nothing but this, okay, should be capitalized. Here is the major difference. Exchange rate fluctuation will not be taken to the revenue account, it will be taken to the capital account. Once more I am repeating, and in our income tax law, exchange rate fluctuation will not be taken to the revenue account, it will be taken to the capital account. It will be added to the cost of the asset. It will be added to the cost of the asset. Once more, exchange rate fluctuation. What is exchange rate fluctuation? Exchange rate fluctuation, there is nothing called restatement, etc. Record it first on the import date. Then exchange rate is only on the date of payment. Year end, there is no adjustment here in our income tax law. Only on the date of payment, I make the next adjustment. Only on the date of payment. So I pay more or less, that should be added to the cost of the asset or reduced from the cost of the asset. It should not be taken to my revenue account. It should not be taken to my revenue account, which is very different from your AS11 or Ind AS, okay, which says it should be taken to the revenue account. Is the clause clear? Is the clause clear? Okay, write down. Section 43A hyphen adjustment for exchange rate fluctuation. Adjustment for exchange rate fluctuation. Full stop, continue. Okay. Any fluctuation between the date of payment and transaction date, any fluctuation between the date of payment and transaction date should be adjusted with cost of asset. Should be adjusted with cost of asset. Full stop, continue. I think I still have that amount column. You are writing it in that particulars column, I believe. If you are not, no problem. We are going to write the amount column as XXX after writing this. Full stop, continue. Hedging, okay, hedging or forward contracts. Hedging or forward contracts will also have same impact. Will also have same impact. So even if you're not put the amount column, now if you put it XXX, okay, now if you can put XXX, fine. Once more repeating, my dear friends. What is cost of addition? Whatever in our accountancy we read, installation charges, freight and cartage charges, all expenses before putting the asset into use, and any other traveling expenses, etc. Apart from this, what are all income tax law says? Cost of trial run, borrowing cost till the asset is put to use. Then the most important, exchange rate fluctuation. First, we need to understand what is exchange rate fluctuation. It is not from the year end date, etc. Exchange rate fluctuation is the difference between the amount paid on the date of payment and the amount of cost of asset which is recorded. If it has increased, then add it. If it has decreased, reduce it. Am I clear to you? Are you understanding? Okay. Less, the following will be reduced. Less sale value of asset in trial run. Sale value of products generated in trial run. Sale value of products generated in trial run. In the amount column within bracket XXX. In the amount column within bracket XXX. Input credit if available. Input credit if available. So if you take an input credit, that will not form part of cost. Input credit if available. And last item which we have already seen, subsidy, provided it is a depreciable asset. Subsidy, provided it is a depreciable asset. amount column XXX. The final amount now is known as cost of asset. The amount now you get is known as cost of asset. Friends, once more I am reading it. What is cost of asset? What are all will be included apart from the purchases? Installation, inverts, expenses till the asset is put into use, including cost of training, travel expenses for purchase of asset, etc., trial run cost, interest till the asset is put to use, pre-production expenses, lifetime taxes, and comes the most important item of exchange rate fluctuation, difference between import price and settlement price, the price paid. Under income tax law, this should be adjusted with the cost of the asset. This should be recorded only in the year in which payment for the asset is made. Even in that date year, you would have sold the asset also, but still your exchange rate should be going to the asset value, block value. Normally in account, we might record for exchange rate every year, but under income tax law, the difference will be recorded only in the year in which payment is made. Reduce GST input credit, subsidy, sale consideration for purchase of asset. Am I clear to you? Am I clear to you? Right. Now comes one more note which is important. One more note which is important, my dear friends. We are moving towards cashless economy. Lesser cash in operation. All transactions should take place with the banking scenario. With that, we have provisions all round income tax law. Okay. In the initial introduction class, we said what is approved modes of payment, what is otherwise than by approved modes of payment. I asked you to remember the otherwise than. What are all they? Crossed check, cash, bearer check. Once more repeating, cash, bearer check, crossed checks are otherwise than by. To colloquially call it unapproved modes, otherwise than by. Note. So after this asset value you have written, note. Where any payment is made, where any payment is made on a single day to a particular person, where any payment is made on a single day to a particular person in excess of rupees 10,000, in excess of rupees 10,000, otherwise than by approved modes, otherwise than by approved modes, then it will not form part of cost of asset. Then it will not form part of cost of asset. Then it will not form part of cost of asset. Suppose, my dear friends, 5,40,000 worth of asset I am purchasing, of which this 40,000 I paid by cash. My asset value will only be 5 lakhs and not 5,40,000 and not 5,40,000. Is the class clear? Is the class clear? Okay, right. Request you to read it in the theory material also. Request you to read it once in the theory material or from your notebook. Shall we? Shall we? Okay. I'm going into question number 3 of our depreciation. Opening WDV of the block is 18,75,000. 3 machines belonging to that block were purchased during the year. Agni purchased and put to use in the first half itself. Mission Trishul purchased in September but put to use only in December, second half. And Vayu purchased and put to use in January. On analysis of the book, you understand Agni is imported from Germany, Trishul from Belgium, and Vayu is an indigenous product. The directors of the company have traveled to Germany for purchase of Agni. The cost of travel was debited to P&L. So it should be increased. Trishul was purchased in September and trial run went on till December. Cost of trial run and the product that is produced in the trial run were sold on test basis, realized 40,000. The income and expenditure were taken to the P&L account. The mission cost was capitalized when the euro was 70. Payment was made when the euro is 87.50. Vayu was purchased from an Indian company. The supplier demanded advance payment of the purchase amount 8 months before supply. The same was made by getting a loan from the bank at 12% interest. The repayment will start as soon as the machine was put to use. As a bank policy, 80% of the cost is funded. On further analysis of accounts, you understand that the company has made a payment of 2 lakhs, that is for $2,500 on 1st November for machine imported in the past years. The machine was imported when the dollar was 70. That machine is sold during the year for 84,000. Even if the machine has sold, the exchange rate should be capitalized because it is block of asset method. It is block of asset method. It should be capitalized. Read the question once or twice completely. Before doing the depreciation, let us understand what is the cost of addition for each of the item. Okay. Cost of addition. Particulars. Agni, Trishul, Vayu. Together we do. Together we do. Please start. Add. traveling expenses of director, okay, wrongly recorded as revenue item. So the traveling expenses of director 2,84,000 should be capitalized. Cost of trial run. Cost of trial run. Okay. Exchange rate fluctuation according to section 43A, difference between date of recording and date of settlement should be adjusted with cost of asset. According to section 43A, difference between date of recording and date of settlement should be adjusted with cost of asset. My dear friends, I had imported this machine when the euro was 70. Okay, so understand this. Okay, 11,80,000 is the value recording date divided by 70. 11,80,000 divided by 70. How much euros are we getting? How much euros are we getting? Can you please work out and tell me? 11,80,000 divided by 70. How much? What is the euro value we are getting? 16? Okay, 16,857. Okay, 16,857. Okay, okay. Date of settlement, okay, 16,000 into 17.50 into increase by 17 rupees 50 pies. Increase by 17 rupees 50 pies. How? 87.50 minus 70. Recording date is 70. Now it is 87.50, my dear friends, into 17.50. I'm getting 2,95,000. Is the class getting it? 2,95,000. Are you all understanding, friends? Are you all understanding how I computed? Okay. Online friends, are you all understanding?
Yes, sir.
Yeah, thank you. Now, I am going to the third important point. value purchased from an interior, the supplier demanded advance payment of the purchase money 8 months before supply. So what is the purchase value of value? 12,65,000. 12,65,000. Remember, 12,65,000 I need to pay advance 8 months before purchase. The same was then by getting a loan. The loan was 80% of the cost. Okay, borrowing cost. That is interest before putting the asset into use. Friends, please understand, 12,65,000 into 80% loan amount into what is the interest rate? 12%. Okay, 12% is the interest rate into 8 by 12. Okay, period before usage. Okay, once more, cost of the asset, out of that 80% gets funded and the rate of interest is 12%. I have got the money 8 months before the date of purchase. Repeating, into 80% into 12% into 8 by 12. Any doubt in this? Are you all clear? You are getting it right? What friend? You are getting it right? Okay. Settlement of old asset. Settlement of old asset. On further analysis, you understand that the company had made a payment of 2 lakhs. Okay. Amount paid during the current year, 2 lakhs. Less import value. It was imported when the dollar was 70. Okay, 2,500 into 70. 2,500 into 70. Okay, increase in the block value due to exchange rate fluctuation. Increase in the block value due to exchange rate fluctuation, another 25,000. Another 25,000. My dear friends, this and this are more than 180 days. The other two are less than 180 days. These two are for more than 180 days. This is August and this is an old asset for which settlement is made. More than 180 days. The other two are less than 180 days. Shall we go for computing depreciation? dear friends, less depreciation. Please understand this into 7.5%. Asset purchased and put to use for less than 180 days into half of the rate plus the balance, this minus this into 15%. That is 64,20,960 minus 29,00960 into full rate. Please ask me if there is a doubt. All of us, friends, have we done it? Shall we move on? Shall we move on? So this is about computation of eligible depreciation in the cost of addition. What are all things that we will include? What are all the things we will include? Okay. Okay. These are all the things which will be. Remember exchange rate fluctuation. Remember even hedging and forwarding will be taken as exchange rate fluctuation. Okay, right? Shall I? Okay. I'm still in addition. We have just started opening WDV. Last year's closing WDV becomes current year's opening WDV. And then we are speaking about additions. We are speaking about additions. I am progressing on additions. Please listen. Now, I have an asset which I purchased for 1 lakh. Okay. I have depreciated so far. Okay. Depreciation for various years. Put together 60. Okay. Now the WDV of the asset is 40,000. Now the WDV of the asset is 40,000. And we all know 6,000 rupees is going to be the depreciation if it is a 15% asset. And the depreciation is going to keep on coming down. Keep on coming down. So what I do is, please understand, what I do is, I sell this asset and purchase back the same asset for 2 lakhs. I sell the same asset to some of my friends and purchase back the same asset for 2 lakhs. Now I can claim 30,000 again as depreciation. What was originally 40,000 in my books, I sell the asset and buy back the same asset at a higher cost. You understand? The law wants to prevent such practices. The law does not want to encourage. The law wants to prevent such practices. So came a provision where assessee purchases back the same asset. Where assessee purchases back the same asset. Cost of asset will be either the purchase price or value at the time of sale. Whichever is less. Either the purchase price or value at the time of sale, whichever is less. So I can record the asset only at rupees 40,000. I can record the asset only at rupees 40,000. Any doubts, please let me know. Any doubts, please let me know. Are you clear? Okay. No, please wait. Please wait. I purchase a second-hand asset. I purchase a second-hand asset. The purchase price, the cost of addition can be actual purchase price or fair market value of the asset, whichever is less. Suppose it is available in the market for 40,000, 50,000. I purchase it for 1 lakh. You understand? Okay. No. What are all the special cases for addition? Please listen. What are all the special cases for addition? Suppose an asset for which I have already claimed 100% deduction. For which asset you will claim, sir? If an asset, though the section is going to come later. if I purchase an asset for scientific research purposes, if I purchase an asset for scientific research purposes, I can claim 100% of the asset value as deduction. Okay, though we are going to study section 35 next week. Okay, I can claim 100% of the asset value as deduction. Now I am bringing the asset to my regular operation. I purchased the asset for scientific research. Now the research is over. Now I am bringing the asset to regular operation. What value I can record in the block? What value I can record in the block? I have already claimed 100% deduction. So what value I can record? What value I can record? 0. You're clear, no? 100% I have already claimed. Okay, please understand. Okay, have it in our material on hand. Have the material on our hand. Okay, where asset is used in the business after it ceases to be used for scientific research, the value to be recorded is nil. The value to be recorded is nil. Okay. Third case, asset earlier transferred, reacquired by the assessee. Asset earlier transferred, reacquired by the assessee. Book value at the time of transfer or actual purchase price, whichever is less. Book value at the time of transfer or actual purchase price, whichever is less. Purchase of second-hand asset. Actual purchase price or fair market value, whichever is less. Actual purchase price or fair market value, whichever is less. Are you clear so far? Are you clear so far? Okay, now friends, I want you to understand this. There are 3 cases of succession. Okay, 3 cases. Remember, amalgamation, demerger, conversion. When I say conversion of partnership firm into a company into LLP, sole proprietor into company. All these things are known as conversion. What is meant by succession? Amalgamation, demerger, and all types of conversions are known as succession. In law, we call this as succession. Okay, what is succession? Merger, demerger, conversions. Let me talk to you. A Limited amalgamated with B Limited. A Limited amalgamated with B Limited. All assets of A Limited are taken over by B Limited. At what value they can take over? Raja? Fair market value? Only book value under income tax law. Income tax law recognizes amalgamation in the nature of merger. Whatever is the value prevailing in the books of accounts can only be taken. Okay, WDV, okay, WDV of previous owner. Okay, WDV of previous owner. A Limited's assets are taken over by B Limited. B Limited can only record it at the value prevailing in the books of A Limited. WDV prevailing in the books of A Limited. Is the class following? Is the class following? Okay, demerger, conversion. A firm converts into a company. The company can record the value of asset only as it is prevailing in the books of the firm. Only in the books of the firm. And in this, I am adding one more item, holding and subsidiary company. In this is also subsidiary company takes over an asset from the holding company, or holding company takes over an asset from the subsidiary company. In all these cases, remember, transfer by holding company to 100% subsidiary company, amalgamation, demerger, conversion, WDV, prevailing in the books of the transferor entity. WDV prevailing in the books of the transferor entity. Any doubt, ask me. WDV prevailing in the books of the transferor entity. So far, am I clear to you? So far, am I clear to you? Now, one more case I am going to tell you, which is also giving the same answer. I purchased a building 5 years back. I purchased a building 5 years back. So far, I am using it for my residential purpose. So far, I am using it for my residential purpose. Now I am going to use it for my office purpose. Now I am going to use it for my office purpose. What is the value of the asset I can record? Asset account debit to proprietor's capital account. What value I can record? Okay. Remember, building transferred to business. Building transferred to business. Gift. Okay. Foreign company transferring asset to Indian branch. Foreign company transferring asset to Indian branch. My dear friends, in all these three cases, how does I work out the cost of the asset? Please understand, cost of addition. Original cost minus depreciation that would have been claimed had asset been used for business from day one. Original cost, 5 years back I have purchased the building. For 5 years, put the depreciation and find out the value as on 1st April. And find out the value as on 1st April. Original cost minus depreciation, building brought into use for business purposes subsequent. Depreciation that would have been taken on the actual cost, okay, had the building been used for the business from the date of its purchase. Asset acquired by gift or inheritance. Actual cost to the previous owner minus the depreciation, assuming it is the only asset in the block. Asset which is acquired by non-resident outside India but brought to him to India for the purpose of business. Actual cost minus depreciation that would have been allowable in India since the date of its acquisition. Since the date of its acquisition. Are you understanding? Please read this table once. Special cases of addition.
Sir,
Yes, friend.
sir, if asset is purchased and put to use for business purpose, the depreciation we are calculating is that is prevailing in this on this now date or previous date, sir.
See, you mean to say the rate, right?
Ah,
Rate from the year of purchase.
அப்போ இருந்த ரேட் கால்குலேட் பண்ணிக்கணுமா இல்லை இப்போ இருக்கிற ரேட் எடுத்துக்கணுமா?
இப்போ ஒருவேளை ரேட்ல சேஞ்ச் இருந்ததுன்னா சேஞ்ச் ஆற டேட் வரைக்கும் தட் ரேட், ஆஃப்டர் த சேஞ்ச் திஸ் ரேட். Suppose
Okay,
2
sir.
years back the rate was 25%. For the first 2 years compute 25%. After that you compute 15%, something like that.
Okay, sir.
Shall we understand it practically? I mean, question number 4, part 1, which is a very interesting question to work out. Okay. So practically these scenarios will not come, but from the theoretical angle, just to understand. Ramesh, after putting into use an asset on 15/12/21, a machine worth 3 lakhs, which is eligible for 15%, sold it on 1/1/24 for 3,20,000 when the fair market value was 250. Okay, to Ganesh, who after using the asset for his business purposes sold it back to Ramesh for 3,20,000. Compute the amount of depreciation and capital gain for the respective assessment years, assuming that this is the only machine in the block held by both, which means that if there is a sale, the block is gone. If there is a sale, the block is gone. Okay. See, Ramesh purchased it in 21, transferred it in 24 or in 23/24 to Ganesh, who immediately transferred it in 24/25 back to Ramesh. How does this work? Read it, we will start working. Shall I work out, friends? Shall we start? He purchased on, okay, for FY, okay, purchase price on 15th December 21. Purchase price on 15th December 21, 3 lakhs, less depreciation at the rate of 7.5%. Okay, put to use for less than 180 days for 21/22. Value as on 1st April 22. Less depreciation at the rate of 15% for 22/23. Friends, please remember, what happens is he sold the machine to Ganesh on 1/1/24 for 3,20,000 less sale value 3,20,000 less sale value 3,20,000 short-term capital gain for financial year 23-24, as this is the only mission in the block. If it is sold, block cease to exist. Shall I proceed? Up to this, have you completed? Have you understood also? Have you understood also? Okay. Shall I proceed? Okay. When Ramesh acquires it back on 15th November 24, according to law, the acquisition price can be WDV at the time of sales or actual purchase price, whichever is less. WDV at the time of sale. WDV at the time of sale is nothing but 2,35,875. Actual purchase price, which is he purchased it for 3,10,000. Whichever is less only can be recorded as cost of addition. Whichever is less can only be recorded as cost of addition. This is nothing but this value. Am I clear to you? Any doubts, friends? Please ask me. Any doubts? Please ask me. Okay, they want to discourage the practice. That's why they have brought this provision. Otherwise, people will, once the value comes down, suppose a computer, which is 40% depreciation, in 3 years, the value would be much lesser. Okay, they sell it and buy it at a higher value. Okay, to avoid such practices, these provisions are kept. And please remember, because one doubt will always come in our mind. When Ramesh acquires back on 15th November 24, cost of addition will be WDV at the time of sales. Sir, at the time of sales means, should I find it out on 15th November 24? Or I mean, at the time when he actually sold? Always depreciation is a 31st March concept. At the time of sale means 1st April value. At the time of sales means 1st April value, no other value. In income tax law, you cannot provide depreciation during the year. It can only be 31st March. Okay. Now I'm going to work out for Ganesh. Remember, Ganesh purchases a second-hand asset. What Ganesh is doing is, he is purchasing a second-hand asset. Okay. According to section 43, cost of addition will be actual cost or fair market actual purchase price or fair market value of the asset on the date of purchase, whichever is purchase price on 1st Jan 24, 3,20,000, FMB on that date. Because January only it has been purchased, I can only claim like this. Friends, from today we start some practice. Okay. This question and this question are homework. They are next to 2 questions. Just that I am reading the question. Sudarshan purchases a building for 20 lakhs. Let it out for dwelling purposes till July 24. The tenant vacates and on 11th July he converts the building. So we have to find out the 1st April 24 value. Okay, as if the asset has been purchased, has been used for business from the date of purchase. 10% is the depreciation. A foreign company purchases computers and a biogas plant. These were used outside India on 1st March 25. Even though it is transferred on 1st March 25, I need the 1st April 24 value only, because I cannot have any other value. Okay, the company starts manufacturing business, transfers them to Indian factory, find out the value to be recorded, and the rates of depreciation is given. You have to give me the value. Okay, this is the principle with which we are going ahead. I know that my exams might be later or whatever it is, but I wish you spend half an hour in answering, not more than that. I will not give you to work more than half an hour. Okay, these two questions plus one more question today, and you need to send me the answer. And this is very important, because I'm not a mobile freak person. I generally don't use it. Okay, so 9 p.m. to 10 p.m. is the time in which you can send me the answer. Tonight, 9 p.m. to 10 p.m., I will wait for your answers. Okay, you have to just put I don't want the working and all. Just type the answer and send me. Just type the answer and send me. For those who are seeing the recording at a later date also, anybody who is seeing the recording of this video, please ensure that you write which chapter, which question number, and send me on any day from 9 p.m. to 10 p.m. That's known as students' time. Okay, if at all I'm not available at that time, I will definitely communicate to you. Some other day we will check. I will check the homework. Don't send me the picture, only send me the answer. When the answer is not matching, I'll ask you to send the picture, or I will check how it is to be worked out. Okay, kindly tonight, okay, we'll start on this Vinayak Chaturthi day, the homework principles also, 9 p.m. to 10 p.m. These two and one more question. Maximum half an hour, not more than that you need to work. Am I clear to you? This is about special cost of additions. This is about special cost of additions, my dear friends. This is about special cost of addition. Coming back. Okay, we completed opening WDV. Now only we completed additions. Okay, additions. Why are we dividing additions into two? More than 180 days, 180 days or more, less than 180 days, because of computing depreciation. Okay, only in the year of purchase we do that. Suppose there is an information, an old asset which is there in the opening WDV. An old asset was used for less than 180 days during the current year. You will charge full depreciation. Only for asset purchased during the year, you need the bifurcation of 180 days or more, less than 180 days. Because if it is 180 days or more, you can charge full depreciation. If it is less than 180 days, you can charge half of the eligible depreciation. Is the class so far clear? Okay, this is addition, cost of addition, special cases of addition. Now I come to deletion in our notebook. Okay, concept of deletion. Concept of deletion. Sale value of asset which is transferred, sale value of asset which is transferred, comma, discarded or demolished. Sale value of asset which is transferred, discarded or demolished will be reduced from the block value. Will be reduced from the block value. Sale value of asset transferred, discarded, demolished will be reduced from the block value. Full stop, continue. This can also be the insurance compensation. This can also be the insurance compensation received on loss of asset. This can also be the insurance compensation received on loss of asset. About this, I will speak more in capital gains chapter. We will speak more about this in capital gains chapter. Okay, insurance compensation. Full stop, continue. Friends, I want to understand this. I have been using an asset for 10 years. I have scrapped the asset. I have not sold it. Remember, I have not sold it. I have put the asset in my godown or thrown it out. What happens? What happens? What happens? Same like deletion. That is, whatever is the cost of the asset, you will delete from the block. That's what you are saying. Any other answer? The answer is, that's what he is saying. Whatever is the scrap. Scrap is nothing. I mean, I have not sold it to realize anything. The answer is nothing happens. In income tax law, unless there is a value, you cannot take it out of the block. Which means you will continue to claim depreciation on that asset. Why? Because it is block of asset concept. I will never know what is the value of the machine which is scrapped. You are understanding? Okay. Full stop, continue. Unless money is received. Unless money is received or receivable. Unless money is received or receivable, an asset cannot be taken out of the block. Unless money is received or receivable, an asset cannot be taken out of the block. An asset cannot be taken out of the block. Okay, remember this. You need to have a monetary value. Then only I can remove the asset from the block. Okay. And then comes concept of depreciation. So this is over. Concept of depreciation. Point number 1. Depreciation is mandatory. Depreciation is mandatory. Am I clear? Depreciation is mandatory. Okay. This question you will see in some chapters in 1 or 2 areas, but this question will also be in your mind. This year I have a loss. Need to claim depreciation. Let the machine value be as it is. Let the machine value be as it is. Next year I will claim depreciation. That option is not there with me. Depreciation is mandatory. Depreciation is mandatory. Full stop. It is either claimed or deemed to have been claimed. It is either claimed or deemed to have been claimed. Okay, right? Are you aware of, though we will study later, are you aware of this section 44 AD, 44 ADA? Any idea about these sections? What is this? Presumptive computation. Very good, Raja. Presumptive computation. 8% of my turnover is my income. 50% of my gross receipt is my income. Suppose, understand. My turnover is 90 lakhs. 8% income. For 3 years, I am declaring under 4480. Now my turnover has crossed the 2 crores. No more I can avail the benefit of 4480 because I have crossed the threshold of turnover. Now I have to maintain books and compute my income. I say, sir, so far I was declaring under presumptive method, so I am not charging any depreciation. Now only I am going to charge depreciation for those assets also. No, boss. Depreciation is either claimed or deemed to have been claimed, supposed to have been claimed. You should find out today's 1423-24 value by taking the depreciation for those respective years. So depreciation is mandatory. It is deemed to have been claimed also. Am I clear to you? Okay. Second, only diminishing balance method. Only diminishing balance method. Only diminishing balance method. In income tax law, you don't have any other method, only diminishing balance method. Full stop, continue. However, which means we are speaking about exception. Whenever law uses the word however, we are speaking about exception. However, for electricity companies, straight line method is an option. For electricity companies, straight line method is an option. Okay, right? Third point. Okay. Remember, friends, only straight line method, only diminishing balance method. For a power sector alone, they don't claim. Actually, diminishing balance is beneficial for them also, because you all know SLM rates are very low. In company law, you would have seen it's very low. So it is better to go by, people go only by diminishing balance. Third, depreciation should be at the rate specified in the law. Depreciation should be at the rate specified in the law. You cannot charge depreciation at any other rate except the rate specified in the law. Full stop, continue. Popular rates are semicolon. Under that, my dear friends, asset rate. Rate is a smaller column. Asset rate. Building other than residential purpose. Building other than residential purpose, 10%. Building other than residential purpose, 10%. Residential building, 5%. You will wonder, what is this residential building? My dear friends, staff quarters. That is a residential building. You can claim only 5%. Suppose company has a building which they use it for director's residence, 5%. Residential building, 5%. Okay. Plant and machinery, general rate, 15%. Plant and machinery hyphen general rate, 15%. Plant and machinery hyphen general rate, 15%. Car, 15%. Vehicles used for commercial purposes like running them on hire. Vehicles used for commercial purposes like running them on hire, 30%. Computers and books. Computers and books. What percentage, my dear friends? 40%. Computers and books, 40%. All other, my dear friends, all other plant and machinery. I told you AC, 15%, light, 15%, fan, 15%, machineries, 15%. General rate is only applicable for them. Furniture and fittings, 10%. And last, intangibles, 25%. Intangibles, 25%. Okay, okay, okay. What are all the assets for which I cannot claim? Land, goodwill. Land and goodwill are not specified assets. So intangible will not include goodwill. Please remember, intangible means know-how, patent, trademark, copyright, franchisee agreements are all intangible for, for which I can claim 25%. Am I clear to you? Right. May I? May I? Okay. I want the class to understand this. May I know what is the rate for printer? 40%. Scanner, scanning machines, 40%. Mobile phone, 15%. What is an accessory? What is a peripheral? That which can perform its operation individually. A mobile phone do not need any other support. It can perform its operation individually. You are understanding, right? A mobile phone do not need anything. It can perform its operation individually. If you don't have a computer, do you think you will buy a printer? Will you buy a scanning machine? If mobile can scan, but other than that, will you buy a scanning machine if you don't have computer? So these cannot perform its operation independently. These cannot perform its operation independently. So the parent rate, we take it for this. She said 40%. Why? Have I said printer 40% anywhere? No. Why are you claiming 40% in your office? Because the rate of computer we adopt for printer. Without the computer, the printer. See, leave alone the new technology that it can be printed from mobile phone, etc. But originally, printers and scanners are directly related to computer. Without computer, it has no use. So you take the rate of the parent. Whereas mobile phone, there is something known as an intercom system. In our offices, intercom system, EPABX, these are falling under 15%. These are falling under 15%. My dear friends, these two are most repeated case laws in our question paper. These two are most repeated case laws in our question paper. BSES Yamuna Motors. Computer accessories and peripherals like printer, scanner, server, etc. form an integral part of the computer system and they cannot be used without computers. Depreciation rate applicable for computers need to be applied for them. Whereas EPA, BX and mobile phone in Federal Bank, they are not entitled for higher rate of depreciation as like computers because they can stand alone perform their duty. They can stand alone perform their duty. So I will not give the higher rate of depreciation. Very important case laws. Printer, scanner, server. Along with computer, you purchase some software. You get 40%. Separately, you go and acquire a software, 25% only, intangible. Along with integrated into the Windows is Microsoft 365, Adobe. Okay, various software comes along with the system. You will take 40% because we will take the system rate. Sir, in our TDS chapter, I will again tell you for that tax need not be deducted at source. But if I separately go and purchase a software, 194J is applicable. Are you understanding? Integrated or integral part means higher rate of depreciation. Are you clear? Okay. This is about normal depreciation. The next is additional depreciation. Give me a 5-minute break. We'll go to additional depreciation. We will. Concept of additional depreciation. Concept of additional depreciation. So what happened is, previously means some 20 years before now, 15 to 20 years before, the rate of plant and machinery was 25%. They then reduced it to 15%. Manufacturing sector uses plant and machinery in the initial years to a larger extent. Later too, because the machinery's wear and tear is like that. To promote manufacturing sector and to do all these things, Mr. P. Chidambaram, the then finance minister, introduced a concept called additional depreciation. Point number 1. Available only for manufacturing entities. Point number 1. Available only for manufacturing. You write it as a point itself. Manufacturing entities. Available only for manufacturing entities. Only for manufacturing. I am not saying company, I am saying entities, which means a sole proprietor can claim, a partnership firm can claim, a company can claim. It should be involved in manufacturing. Available only for manufacturing entities. Okay. Next, point number 2. Available only for new plant and machinery. Available only for new plant and machinery. Full stop. Continue in the same point. New means it should not be used before. New means it should not be used before, either in India or outside India. New means it should not be used before, either in India or outside India. Okay. Third point, it should be used directly or indirectly in manufacturing process. It should be used directly. It means that plant and machinery should be used directly or indirectly in manufacturing process. Okay, okay. Now is the time to understand this interpretation where it is available for new plant and machinery which is used directly or indirectly in the manufacturing process. Are you understanding? Okay. When I say new plant and machinery, we know the term plant includes books, computers, vehicles, electronic appliances, electrical appliances, surgical equipments. Everything is a plant. The law is very broad enough to say, computers used in the manufacturing process. Suppose there is a quality checking which the computer only does. You can claim additional depreciation. For vehicles, can you claim additional depreciation? For vehicles, can you claim additional depreciation? A car is there, can you claim additional depreciation? No, it is not used in the manufacturing process. But suppose you can see in major factories, etc., from the raw material to the factory, to the production area, there are vehicles which are coming, which carry the raw material. Forklift are there, which carry the raw material or finished goods or one process to another process. They aid in manufacturing. So, vehicles used in manufacturing process. All these things you can claim additional depreciation. All these things you can claim additional depreciation. So next point, computers, vehicles, which directly or indirectly support the manufacturing process. Which directly or indirectly support the manufacturing process. Will also qualify for additional depreciation. Will also qualify for additional depreciation. Okay, next point. Okay, rate of additional depreciation. Rate of additional depreciation 20%. Rate of additional depreciation 20%. Rate of additional depreciation 20%. Okay, rate of additional only for the year of addition. It is not for opening balance. It is only for purchases made during the year. It is only for purchases made during the year. You are all understanding, right? Rate of additional depreciation 20%. Now, I want you to understand this interpretation. Rate of additional depreciation 20%. Understand this. Friends, used for less than 180 days. Used for less than 180 days, what is the eligible rate? Then half, 10%. Rate of additional depreciation 20%. By interpretation, we understand if it is used for less than 180 days, half of the eligible rate, so 10%. Now, a company, Forgings, went on a case law to court. The finance minister in their budget promised me rate of 20%. Income tax law gives me only 10%. The finance minister in the budget speech promised me 20%, whereas income tax law only gives me 10% because I am using it less than 180 days. The income tax department said, boss, it is not that I am giving you 20%. By law, by interpretation, we understand if an asset is put to use for less than 180 days, you can claim only half of the rate if what the finance minister promised is the rate, and by interpretation, half of the rate, 10%. Court said, please understand, court said, harmonious construction. Two provisions are spoken in two different ways. One, finance minister promised 20%. It is income tax law is not doing a wrong. Income tax assessing officer is not doing a mistake by giving 10% because you have used it for less than 180 days. But court want to give the benefit to the assessee by harmoniously constructing both the provisions. So the law said, write down, where assessee only claims 10% in the first year. Where assessee only claims 10% in the first year. Why should he claim 10% in the first year? Because he is using it for less than 180 days. Where assessee only claims 10% in the first year. Then the balance 10% can be claimed in the immediate succeeding year. The balance 10% can be claimed in the immediate succeeding year. So now law is also fulfilled, finance minister's promise is also fulfilled. Okay, now please understand, in the financial year 23-24, I claim only 10% because I have purchased the asset after 4th October. So I have only claimed 10%. The balance 10% can be claimed in the financial year 24-25 for the same asset. Is the law clear? Is the class clear? Okay. Okay. So, additional depreciation. Additional depreciation. Friends, again, I am going into small nuances. Additional depreciation is claimed on the addition. Is it claimed on the opening balance? Is it claimed on the opening balance? Now, to make you more clear, I'll just now please understand. Please understand. Normal depreciation is claimed on balance available in the block. We claim for this 7.5% and for the remaining 15%. Whereas additional depreciation is claimed on asset acquired during the year. And if I have acquired and put to use for less than 180 days, the balance 10% in the next year. Is the class clear? Is the class clear about this? Why I am taking this time is, by interpretation of law, we understand, even if the block is out of existence, still additional depreciation can be claimed. Because Additional depreciation is not on the balance available. Sir, during the year I have purchased an asset. Some last purchased asset sold, and it is sold at an exorbitant value, so that the block has gone out of existence. You cannot claim normal depreciation, but you can claim additional depreciation because during the year you have purchased an asset. Okay? Okay? Special points. Special points. Additional depreciation can be claimed even if the block ceases to exist. Additional depreciation can be claimed even if the block ceases to exist. Even if the block ceases to exist. And as I was telling you from class 1, probably we will not be doing additional depreciation in many questions in the future. Point number 2, in a different color pen, please write and keep. Additional depreciation provision is not available for concessional tax regime. Additional depreciation provision is not available for concessional tax regime. So in the new tax regime, if the assessee is following the default tax or new tax regime, there is no question of additional depreciation, only normal depreciation. Read it once. Are you understanding? Are you understanding this? Okay. I am going into the practical question. Mamekam Limited gives you the following particulars of plant and machinery, which is directly used for the purpose of manufacturing. Block 1, Block 2, Block 3, WDV, opening WDV, additions, sale value. Plant A and C were put to use in September. Plant B, March. Compute depreciation. Read the question. Plant A and C, September 57. The third block has gone out of existence. The third block has gone out of existence. The first two blocks, I mean, mistake, 4 lakhs. The first two blocks are there. Look at this normal depreciation. Here it is straightforward. This into 15%. Because asset is purchased in the first half. Here it is 30,000 into 15%, half of the eligible rate. Eligible rate is 30%, so 15%, because this 30,000 will be apportioned here only. Okay. Because this 30,000 will be apportioned here only. Here there is no normal depreciation. Additional depreciation. Please understand, here it is 57 lakh into 20%. 57 lakh into 20%. Here it is 4 lakhs into 10%. And here also you can claim additional depreciation. Okay, 3,40,000. Please understand. Notes. Okay. Point number 1. Okay. Total depreciation is 26,48,300 for block 2 and block 3. Additional depreciation can be claimed even if block ceased to exist or balance is not available. Third note is all the more interesting for block 2. Asset put to use for less than 180 days. Balance of 10% of additional depreciation can be claimed in the next financial year, that is FY 25-26. Any doubts, please ask me now. Are you all understanding? Okay. The year remains no change. XYZ manufacturing concern furnishes you the following. Opening WDV, new plant and machinery purchased in the first half, second half. This is for 23-24. Then you will find out the opening WDV for the current year. New purchased in 17th and 11th August and one acquired in the second half. Compute depreciation for both the years. Go ahead, please. Go ahead. Go ahead. This is the answer I am getting. The answer is on the screen. Am I clear? You got it? Online students, Mona, Mohana, Priya, Revati. Are you all getting this?
Yes, sir. Yes, yes, sir.
Yes, sir.
So, right, we progress. Lights and powers engaged in the business of generation and distribution of power. Power is also manufactured. Biotechnology, manufactured. Every these things are also manufactured. Furnishes the following particulars: computation, depreciation available. That company has opted for the depreciation on the basis of written down value. Opening WDV, purchase of second-hand machinery, purchase of second-hand machinery. Can they claim additional depreciation? No. Additional depreciation is only for new machinery. Remember. Machine Y purchased and installed on 12th July. Acquired and installed a new air pollution control equipment. New air conditioner purchased and installed in office premises. That is also 15%. Remember, it is not for power, it is for office. So only normal, no additional. New machinery acquired and installed on 23rd for generation of power, sold old machinery. So this is the third of the homework questions. So 3 homework questions for you today. Okay, I'll wait for your answer at 9 to 10. Please remember 3 homework questions. For those who are seeing the recording, please do the homework and send me the solution. Only the answer. Only the answer. But I don't know when you are seeing what chapter, etc. You need to specify the chapter and send me so that I'll be able to check it. 9 to 10 p.m. on any day. If I am not available on the subsequent day, I will definitely look into and give you all the homework solution. Am I clear to you? Okay. This is about additional depreciation. So with this, we come to this end of this format, my dear friends. End of this format. We have understood every line in the format. We know what is opening. We know additions, cost of additions, how to record special cost of additions, what is meant by sale value, the normal depreciation, and the small nuance of additional depreciation, where asset is used, etc. Remember, additional depreciation is not available for new tax regime. Am I clear to you? Okay. Right. Concept of unabsorbed depreciation. Namaste. Good morning. My dear friends, we continue our understanding into depreciation. Yesterday, we started with the format. We completed the format of opening, additions, deletions, normal depreciation, additional depreciation. We completed up to this. Okay. I walk into a concept called proportionate depreciation. I walk into a concept called proportionate depreciation. Proportionate depreciation. Yesterday only I was telling you there is no concept of proportionate depreciation under income tax law by having it as 9 by 12, 3 by 12, 8 by 12, 1 by 365. These things are not a concept in income tax law, but now I am writing what the proportionate depreciation. Am I contradicting, or is there a, I'm still holding good my my teaching that there is no concept called proportionate depreciation under income tax law. There is no concept called proportionate depreciation under income tax law. This concept is not proportionate computation of depreciation. It is proportionate distribution of the depreciation. Repeating, here we are not going to talk about proportionate computation. This 8 by 12, 7 by 12 is not there in income tax law. 3 by 12 is not there. It is proportionate distribution, where two organizations have to claim depreciation for the same asset. Repeating, where two organization has to claim depreciation for the same asset, then we will compute the depreciation and distribute it proportionately. And distribute it proportionately. That is what is this concept called proportionate depreciation. Okay. Now this leads us to a question of when should two organizations claim depreciation for the same asset? Okay. In the case of succession. In the case of succession. What is succession? Amalgamation, demerger, conversion. Three types of conversion: sole proprietor to company, firm to company, company to LLP. So if this happens in between the year, A Limited amalgamates with B Limited and the process is completed on 17th July. So 1st April to 16th July, A Limited has to claim the depreciation. 17th July to 31st March, B Limited has to claim the depreciation. The law says, while computing, don't do so. Compute the total depreciation, distribute it on proportionate basis. Distribute it on proportionate basis. That is known as proportionate depreciation. It is just distribution and not computation. Am I clear to you? Okay. Where, write down. Where two organizations has to claim depreciation on the same asset. Where two organization has to claim depreciation on the same asset. Where two organization need to claim depreciation on same asset. Then depreciation will be computed. Depreciation will be computed and distributed to both organizations on a proportionate basis, and distributed to both organizations on a proportionate basis. Okay. So when will this be applicable? Okay. Amalgamation, amalgamation, demerger, succession. Amalgamation, demerger, succession. In these cases, it will be. Okay. Succession is what is conversion? Okay. Sorry, conversion. Sorry. Succession is all these things. Yeah, you are right. Conversion. Okay. Amalgamation, demerger, conversion. Okay. In these cases, it will be applicable. Depreciation will be computed. Depreciation will be computed ignoring the event. Okay, my dear friends, as if amalgamation, demerger, or conversions did not take place, as if the succession did not take place, the depreciation will be computed. As if the succession did not take place, the depreciation will be computed. Okay. We will first compute the depreciation. That is, we will compute the total depreciation as 7,08,000. Okay. We know that we cannot take it at a value other than the book value prevailing, and that needs to be distributed between the two entities based on effective usage period. Based on effective usage period. Any doubts? Shall I proceed? Shall we do one more question to get the concept clear once more? May I? Pushpak and Co., a partnership firm, was converted into a company, and the conversion was completed with effect from 1st November. However, the company commenced business and started using the asset. Effective usage period. Effective usage period is only from 1st month. Effective usage period is only from 1st March. The opening WDV of plant and machinery and computer. On 1st June, plant and machinery of 1990 was purchased and immediately put to use. No further investments were made. Compute the depreciation that the firm and the company can claim. Read through. This is also 19,90,000 into 15% only. It is purchased in the first half. Why I am doing like this, you all know. That is to find out. Otherwise, if it is not a proportional depreciation question, I would directly put 4630 into 15%. If it is not a proportional depreciation question. The company has only started using the asset from 1st March. The company has only started to use the asset from 1st March. So the effective usage period for the company will not be from 1st of November. It will only be 1st of March. Remember, depreciation has to be distributed on effective usage period. April, May, June, July, August, September, and October. Here 31 days. It is only effective usage period of 245 days. 245 days. Are you all understanding this? Are you all understanding this? June, July, August, September, October. check whether you understand this. Are you understanding this? Any doubts? How I got to 1/4? That is for firm 1st April to 31st October. For firm 1st June to 31st October. For company, that's how I got it. Shall we? Shall we? Yeah. 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 Anybody still doing? Online friends, shall I? Concept of unabsorbed depreciation. Concept of unabsorbed depreciation. Concept of unabsorbed depreciation. Concept of unabsorbed depreciation. Okay, friends? Okay, right, right. Please listen. So I prepare a P&L account. My gross profit is 40 lakhs. My operational expenses or cash expenses is 35 lakhs. And my depreciation comes to 10 lakhs. Okay. And there is a net loss of 5 lakhs. There is a net loss of 5 lakhs. Under our income tax law, we don't call it as loss. We call it as unabsorbed depreciation. We carry forward it as unabsorbed depreciation, where the profit available 5 lakhs, 40 minus 35, 5 lakhs, where the profit available is not sufficient to cover the whole of depreciation. The uncovered portion of depreciation will be carried forward as unabsorbed depreciation. This will be carried forward as unabsorbed depreciation. Okay. Gross profit 40 lakhs. operational expenses 45 lakhs, depreciation 10 lakhs, giving me a net loss of 15 lakhs. Under our income tax law, we carry forward it as business loss is 5 lakhs. Okay. Whatever is the loss due to operations is business loss. Whatever is the loss to depreciation will be carried forward as unabsorbed depreciation. As unabsorbed depreciation. Is the class understanding? Is the class understanding? This is not current year. It will be carried forward as unabsorbed depreciation. Am I clear to you? First write these examples, I'll go to the theory. Your theory material. Shall I progress? Shall I progress? Okay, friends. Okay, this is carry forward of unabsorbed depreciation and carry forward. Now, what advantages do I get because of unabsorbed depreciation? Advantages. Okay. Okay. Carry forward even if return of income is belated. Even if it is late filing of returns, you cannot carry forward business loss, but unabsorbed depreciation you can carry forward. The advantage carry forward even if return of income is filed belated. Okay, carry forward even if return of income is filed belated. Okay, carry forward for indefinite period. There is no 8-year restriction in the case of unabsorbed depreciation. It can be carried forward for indefinite period, can be set off against any income. The best advantage we have here is it can be set off against any income. Once more from the top, the advantages of unabsorbed depreciation are it can be carried forward even if return of income is filed late. It can be carried forward for indefinite period, and it can be set off against any income, not necessarily business income. Not necessarily business income. Am I clear to you? Am I clear to you? Okay. Close to 4 hours of depreciation we have discussed. Okay. I am repeating. Depreciation is a important concept in a main question. It can come a very. So from the top, if I am looking at depreciation, first we saw which are all the assets for which depreciation can be claimed. The two assets for which depreciation cannot be claimed are land and goodwill. So it is not a specified asset. For all other assets, it should be owned by the assessee. What did I ask you to remember there? Beneficial owner can also claim. A. Sivakami and Co. The HUF case. Okay, right? Then it should be used for the purpose of business or profession. The terminology usage is three things has to be remembered. Active usage, passive usage, ready to use is put to use. Ready to use is put to use. And the fourth condition is block of asset method should be followed. In this usage, and we also saw ICDS limited case law where the lessor can claim the benefit of depreciation even though substance over form. Okay, we saw that and progressed towards the format of claiming depreciation. In that, we divide addition into two, 180 days or more, technically October 3rd, less than 180 days, because if it is more than 180, I can claim full depreciation, eligible depreciation. And if it is less than half of the eligible depreciation, this is only for the year of purchase. The statements can confuse you. They have sold an asset after using it for 180 days. Boss, in the case of sale of assets, there is no depreciation. Because in income tax law, depreciation is a 31st March concept. And whatever assets are there on the 31st March evening only, I will claim depreciation. Or that's why I arrive at a value called amount available for depreciation after reducing everything. Additions, we saw a detailed thing. I want you to remember three things which are always repeated. 43A, Forex. Okay. It can be hedging contracts also. Between, first I will record it on transaction date. The next time I will record it is only on the payment date. No other in between time. On the payment date, whatever is the Forex, I will adjust it in the block of asset or with the cost of the asset. Okay. Borrowing cost, till the date of putting the asset into use, the borrowing cost should be capitalized. Okay. And we saw this and then we saw that depreciation. We saw FedEx case law where we said what is an accessory, and also we saw the case law of what is a standalone asset, mobile phone and EPAPX. Okay, these and then we computed normal depreciation, additional depreciation. Additional depreciation is only for manufacturing entities, only for new plant and machinery purchased during the year, used directly or indirectly in the manufacturing process, 20%. If it is less than 10%, claim this year 10%, next year the balance 10%. And then additional depreciation cannot be claimed under the new tax regime, under the concessional tax regime. Then this morning we saw proportionate depreciation. Now we saw unabsorbed depreciation. This is the long travel, 4 types of depreciation. As I told you, it is not a full stop. It is just a comma. We are still going to continue with in many questions depreciation. When we started the yesterday's class, we said that these sections are coming under the bracket of asset-based deduction. We are in the category of 30 to 37 expenses expressly allowed by law. 30 expenses in relation to building. 31 expenses in relation to plant, machinery and furniture. 32 the long travel depreciation. Okay, shall we move out now to section 33? Okay. Section 33. Now, let me talk about the preamble first. Normally, depreciation is only for, Normally, expenditure is only for revenue in nature, or if some kind, a deposit is going to be given as deduction. A deposit, the law has the intention that you should plow back the profit. After you get the profit, you have two options: either to distribute it as dividend, or to take it as drawings in the case of a firm, or the sole proprietor can withdraw it, or keep it in the business and use it for the purpose of business. The second intention is only being looked into for this. They want you to maintain the profit in the organization, use it for the growth of the organization. So deposit it so that I will give you deduction. Okay. And the deposited money, for what purpose it should be used, are all said in this section. This section now has two provisions, one for plantation sector, another for oil and natural gas. When I say plantation, tea, coffee, rubber. Okay. And another is for oil and natural gas. The second is never a questionable area. The first has appeared as question. Okay. Moving into deposit based deduction. Deposit based deduction. I start with section 33AB, plantation sector. Plantation sector. 33AB, plantation sector. Plantation sector consists of tea, coffee, rubber. These three only. Okay. Conditions. Deduction. Consequences. The term consequences means if you don't fulfill the condition, what happens? The term consequences just means if you don't fulfill the condition. That's what consequence. Condition, deduction, consequence. Shall we start? Okay. Available for growing and manufacturing. Available for growing and planting, tea, coffee, rubber. Available for growing and manufacturing. That is, a trader cannot claim. A trader cannot claim. Okay, that the tea shop wala cannot claim. He is also in tea business, but he cannot claim this. This is only for people who are growing and manufacturing. Deposit in special account of NABARD or any authorized bank. Keep the money deposited in a special account either with NABARD or any authorized bank. Okay, keep the money deposited in a special account either with NABARD or any authorized bank. Money should be deposited within 6 months or before due date. of filing returns. Money should be deposited within 6 months or before due date of filing returns. Money should be deposited within 6 months or before due date of filing returns. Are you following? Are you following? Okay. Money should be deposited within 6 months, 30th September. This due date, I don't think it will, because 31st October is the due date, because these are mandatory audit cases. These are mandatory audit cases. So obviously this will be the date. So you can take it as 30th September, but as per law or before due date of filing return. Okay. Okay. Deposited money should be used for purchase of asset to be used in field. Deposited money should be used for purchase of asset, irrigation equipment, tractors, okay, plantation related equipments should be used for purchase of asset to be used in field. Okay. Computers are qualifying. Okay. The only office equipment which qualifies is computers. The only office equipment which qualifies is computers. Computers will qualify. New asset not to be transferred within 8 years. New asset not to be transferred within 8 years. Friends, what are all the conditions? This is available for plantation sector, growing and manufacturing. To avail this, keep the money deposited in the NABARD in a we call it as development account, tea development account, coffee development account, etc. Development account in NABARD or any other bank which is authorized. Make the deposit within 6 months, and the deposited money you should only for purchase of asset to be used in the field for business purposes. Only computer. You cannot use the money for buying car. You cannot use the money for buying air conditioners. You can only use it for the purpose of field asset, and don't transfer the new asset within 8 years. If these conditions are satisfied, you can get a deduction of amount deposited or 40% of profits, whichever is less. If these conditions are fulfilled, you will get a deduction of amount deposited or 40% of profits, whichever is less. Okay. Yeah. If deposit is misutilized, if deposit is misutilized, that is, you are not using it for the purpose of you withdraw the money but did not buy asset to be used in field activity. You are giving rent, you are making some revenue expenditure, you are buying car, you are buying air conditioner for the office. If deposit is misutilized, taxable in the year of withdrawal. taxable in the year of withdrawal. If asset is transferred within 8 years, if asset is transferred within 8 years, if asset is transferred within 8 years, taxable in the year of sale. If sale value exceeds original cost, such excess is capital gains. Such excess is capital gains. So you buy an asset for 3 lakhs and sell it for 4 lakhs. 3 lakhs is business income, 1 lakh is capital gain. Within 8 years you have sold and the sale value exceeds the original cost, then such excess is capital gains. Please read through once.
Asset is transferred within 8 years. Taxable in the year of sale, as in the sale value is taxable in the year of sale.
Yes, friend, because you have already claimed the 100%. From the deposited amount is allowed as a deduction. From the deposited amount, you are purchased an asset and selling it. The entire sale value is taxable in the year of sale. If the sale value exceeds the original cost, such excess is taxable at capital gain.
Similarly, when we are talking about deduction, the amount deposited or 40% of profits implies 40% of the taxable profit.
40% of profits before claiming 33 AB. Am I clear to you? Am I clear to you? Okay. Okay. Now. Friends, please understand some things. These three are, interestingly, partly agricultural, partly business income sector. Tea, coffee, rubber also has one other. We immediately relate to something that, boss, these are considered as partly agricultural, partly business income. Okay? Okay? You're still in your theory notebook only. Split between business income and agri income in case of, okay, plantation sector. Split between business income and agricultural income in case of plantation sector. Shall I? Growing, write down, manufacturing tea. 40% is business, 60% is agriculture. Are you following, friends? Are you following? Are you understanding? Okay. These are remember the split is after allowing 33 AB deduction, not before. Tell me, friend, you have a doubt? I can answer. Personal doubt means to have a to question number 9.
Can you please show the notes, sir?
May I go to the answers? Any other answer, my dear online friends? Okay, sir. So remember, income from sale of coffee, grown, queued, roasted, and grounded in is 100% business income. Only in India, Indian agriculture income, non-resident taxation, I will again tell you, agricultural income earned by a resident from outside India, taxable. Agricultural income earned by a non-resident from India, exempt. Only Indian agricultural income will get the benefit. May I, friends? May I? Okay. Now, how we go about it? Now, listen as to how we go about it. This is just a marking question. Now, question number 10. Dinesh, an individual, is engaged in the growing and manufacturing of tea. For the financial year 24-25, his composite business profit before allowing 33 AB is 60 lakhs. On 1st September, he deposited a sum of 11 lakhs in tea development account. During the year, he has a brought forward business loss of 14 lakhs. Determine the business income. Wait. Okay. Income before allowing 33 AB is 60 lakhs. Deduction under section 33 AB. Remember, that's what I wrote it as a note also. Remember, the deduction is, the split is after providing the deduction. After providing the deduction only the split happens. Okay. Deduction under 33 AB. Amount deposited, how much is that? 11 lakhs. 40% of profits, that is 60 lakhs into 40%. Whichever is less goes to the outer column. Our learning is, when they say brought forward business loss, that should be reduced from the business income. We should not put 49 minus 14 and then go for the split. They are very clear. Brought forward business loss. Probably last year I had 20 lakhs loss. 60% will go towards agricultural loss. 40% will come towards business loss. So always after the split only business. We know a set of chapter comes after all the heads itself. So. May I? May I? May I? Part B. On 25th January 26, he withdrew 10 lakhs from deposit account, which is used as follows. 6 lakhs for non-depreciable asset as per the scheme specified. 3 lakhs for office premises, 1 lakh other expenses.
taxed in the year of redeeming provisions.
Sir, once more, sir.
The amount that is placed for the not allowed is taxed in the year of withdrawal.
Yeah, that's what, sir. It is taxed in the financial year 25-26, sir.
Redeeming 40 only tax.
Not necessarily 41. 33AB itself has the provision. It can be deemed income, but 33AB itself has the provision, so we need not look into 40. May I move on? One, okay. What will be your answer if the machine that is purchased for 6 lakhs is sold in April 27 for 8 lakhs?
And when we talk about 8 years, are we talking from the date of purchase or are we talking financially wise?
I think the answer is there here also. Held for a period of 8 years from the date of purchase, not financial years. Shall I? Shall I? Anybody? Are you understanding, online friends also? Are we in line?
Yes, sir.
Thank you, Vidya. Moving forward. Moving forward now. Okay. Do not worry about this section 33ABA. Okay, which is which is about site restoration fund. Okay, section 33ABA, site restoration fund. Okay, for oil and natural gas. Okay, same conditions and consequences. Same conditions and consequences. Deduction, amount deposited, or 20% of profit, whichever is less. I haven't seen a question in this. Okay, do not worry. The two in a examination batch, I don't want to dwell with it for a longer time. Do not worry about it. Do not worry about it. Okay, okay, right, friends. 30, expenses in relation to building. 31, expenses in relation to plant, machinery and furniture. 32, long travel depreciation. 33, AB is plantation. ABA is site restoration fund. AB is sufficient. Okay. 34 is not there in the law. 34 is not there in the law. That leads us to section 35, which is basically, I told you, motivational aspects, though there is something more to it. But basically, motivational aspects are looked into in section 35.
So what you wrote, sir? 20% of what?
Profits.
Okay.
Section 34 was never there or removed.
No, sir. Now not there, sir. I think for more than 25 years it is not there, sir. It's also like a site restoration fund. Investment allowances were provided in that. It's removed, sir. May I? Can I first? Okay, right. No. This you need not write. This is only for your understanding. Interestingly, subdivision of section 35 is as follows. Subdivision, this is not for your writing, this is for your understanding. Subdivision of 35 is as follows. The main 35 speaks about scientific research expenditure. The main section 35 speaks about scientific research expenditure. 35 AD, the section speaks about specified business. Okay, 35 AD. And then some social welfare expenditure, that is contribution to national programs, agricultural extension program, skill development expenditure. And then comes amortization, that is writing off an expenditure in multiple installments, telecommunication license, preliminary expenses, amalgamation demerger expenses. That's what we are going to see. I'll tell you when I can. So section 35 split is like this: scientific research, specified business. So next to section 32, The long travel section is going to be section 35. If not so much of long travel, but section 35 has lot of inbuilt part in it. We will start with the scientific research expenditure part of it. Section 35. Section 35, scientific research expenditure. Section 35, scientific research expenditure. When I say scientific, I also include social and statistical. I also include social and statistical. Just listen for a few minutes. Okay. This expenditure, this deduction is provided with the intention of motivating to research. Okay. Either you can have an in-house research department and do the research, where you are unable to do it in-house, or even in spite of doing in-house, you want to contribute also to an external agency for the purpose of research, you can do it. Okay. So it can be an in-house research or contribution to external agencies. A startup might have these issues like, I incur the expenditure. Remember, I incur the expenditure. Later only I start the business. If the research is going to be successful, I am going to. Even in that case, we are going to be generous. The income tax law says, okay, fine. The past period expenditure will also be allowed in the first year of operation. Okay. One parent principle, yesterday I told you about section 35. The difference between 32 and 35. If I want to allow as a percentage of asset, 32. If I want to allow the asset itself as a deduction, we will make them fall in the basket of section 35. Always it's well drafted law. Okay, like buckets. Okay, that's what is my personal criticism of DTC. You don't want to use alphabets. You are not following you are not making it falling under the proper bucket. Okay, 35 means these things. Now there is no, they don't want to use alphabet 35 AD AB. How long they cannot use it? Because as soon as the next budget comes, they have to somehow use it. Okay, so let's keep that apart. We'll speak about DTC after you all become chartered accountants. Okay, all right. So now in-house. Now, so this section is basically divided into in-house research and contribution to external agency. Contribution to external agency. One thing I want you to understand this section is applicable for social science, natural science, applied science, statistical. For everything we can use this. Statistical research is also study of human behavior, social science, Maslow, Taylor. Okay, all these people studied how the movement of a body will be able to produce more goods. Okay, piecemeal. Okay, so those social studies, science, real science studies, and statistical research are covered. Okay, so this I call it as coverage. Okay, now let me first focus on in-house research. 100% of revenue expenditure is allowed. For that, I don't need a section. For this, I don't need a section. Okay. The next is the incentive. 100% of capital expenditure will be allowed. even capital expenditure. If you buy an equipment for the purpose of research, the same will also be allowed. 100% of capital expenditure will also be allowed. 100% of capital expenditure will also be allowed. Is the class understanding? Is the class understanding, following? Okay. Where current year is the first year of operation, where current year is the first year of operation, where current year is the first year of operation, okay, 100% of revenue and capital.
The screen is not clear, sir.
Screen is not struck. My dear friends, are
It's
you
not
able
clearly
to?
visible.
For all of you, my dear friends, is it so? For all of you?
Sir, it's not struck, it's not visible.
Yeah, I understand. Is it for all of you? I mean, just trying to find out, is the net connection in my end or other end?
Yes, sir. Yes, sir.
Yes, sir. Yes,
sir. Yes, sir.
Okay, okay. Just give me.
Yes, sir.
Yeah, just give me a minute. Just give me a minute. So, where current year is the first year of operation, 100% of revenue and capital expenditure can be accumulated and claimed. Where current year is the first year of operation, 100% of capital. Yeah, that's okay. You're okay, right? Yeah. 100% of the capital and revenue can be accumulated and claimed.
Clear also.
Hello?
Screen is clear now, sir.
Can you check whether the screen is blurred now?
Screen is clear.
Nothing. The screen was blurred. Now they say it's clean. Okay, no problem. Yeah. Thank you. Okay. So 100% of the revenue and capital expenditure can be accumulated and claimed. Accumulated and claimed. Are you understanding, my dear friends? Remember, cost of land is not allowed. Be it one capital expenditure which I will not allow is cost of land. Not only in this section, in all the sections we are going to see. I told you in this case, in this 35, all the other expenses, that is capital expenses, in none of the sections they are going to allow cost of land. 35 AD we are going to see. Skill development we are going to see. Agricultural extension program we are going to see. In no case cost of land will be allowed. You can be taking it as a ground rule itself. Okay, land ground, correct? Okay, so right, cost of land will not be allowed. Is the class clear? Is the class clear? Okay, shall I proceed? Contribution to external agency. 100% of amount contributed to National Committee. %. This is governments. Okay. IIT, IIM approved research institution, association, approved research institution, association, universities. Approved research institutions, associations, universities. Approved research in, okay. Public limited companies whose main object is research. Public limited companies whose main object is research. 100% of amount contributed to National Research Center, which is run by the government, IIT, IIMs, approved research institution, associations, universities. When I say institution, association, it includes colleges also, it should be approved. And public limited company whose main object is research. Entire amount computed will be allowed. Will be allowed. Am I clear? Am I clear? Now for something to listen, understand, then we can talk about it more detailed. Okay, now it is, I want you to understand. Not allowed under concessional tax regime, that is new tax regime. This is not allowed. 115 BAA to BE, not allowed. Not allowed. Are you understanding? Not allowed. Are you understanding what, Rajagopal? Are you understanding?
Yes, sir.
What is not allowed?
100% contribution tax.
Very good, Rajagopal. I want you to remember this. I never wrote it on the other side. In-house research can be claimed even under the concessional tax regime. As he was correctly saying, contribution only is not allowed. Remember, my dear friends, in-house research is allowed even under the concessional tax regime. 115 BAA to BAE. What is not allowed is only contribution to external agency. That's why I have written it only on the other side, not as a common point. Only on the contribution side we have written it. Am I clear to you? Am I clear to you? And this as a general principle, even in your practical world, remember this. You gave donation to an organization for claiming 80G. Later, the CBDT pulls off or withdraws the approval for that organization. Later, CBDT pulls off or withdraws the approval for that organization. Can you still claim 80G? On the date of contribution, it should be an approved institution. Withdrawal after that, one question will come. Contributed in June. In Feb, that is June 24, I contributed. In Feb 25, CBDT withdraws the approval for that agency. Can I still claim 100%? Yes. On the day of contribution, they are approved. Okay. Subsequent withdrawal will not affect the claim. Subsequent withdrawal will not affect expenditure claim. Subsequent withdrawal will not affect expenditure claim. Read through.
4 to 5 years before they reached to 200% reduction and all, right?
150% is all gone, sir. That is 5 years back. There is no more weighted deduction in our income tax law.
Any specific reason there was?
Sir, why should we give weighted deduction, sir? If you spend 100 rupees, 150 rupees, 100 rupees itself slowly getting withdrawn. Am I clear? Am I clear? Am I clear? Friends, just as one more small item of theory before going into practical application. Asset post utilization. So I purchased an asset. For scientific research. The asset usage is over. I purchased some lab equipments. The asset usage is over. Okay. Post utilization, what happens, my dear friends? Directly sell. If I directly sell the asset, okay, if I directly sell the asset, sale value will be treated as income. Our friend was telling, if you remember, 41, deemed income. Sale value will be treated as income. And if the sale value exceeds original cost, excess is capital gains. Excess is capital gains. If it exceeds original cost, excess is capital gains. Is the class clear? I purchased an asset for 2 lakhs. After usage, I sell it for 1 lakh. Entire 1 lakh business income. I sell it for 2 lakhs. Entire 2 lakhs business income. I sell it for 2 lakh 20,000. 2 lakhs business income, 20,000 capital gains. Transfer it to block. Transfer it, instead of selling it, I transfer it to block. I transfer it to block. What should be the value of asset recorded in the block?
0.
Sir?
0.
0.
The claim amount.
Yeah, 100% has been claimed. Okay. Cost of addition to block is nil. Subsequently, when it is sold, sale value is reduced from block value. Subsequently, it is sold, sale value is reduced from block value. Am I clear to you? Subsequently, sale value is reduced from. So scientific research expenditure in-house 100% allowed except cost of land. Contribution to external agency 100% allowed for national lab, that's known as national lab. Scientific research association, institutions, colleges approved. IIT, IIMs, public limited companies whose main object is research. Subsequent withdrawal also you can claim provided on the date of donation it was a approved institution. Remember, this cannot be claimed under new tax regime. And also remember, scientific research means even social and statistical research. I mean, question number 11. I mean, question, tell me. Remote is here. The following are the details of Orchid India Limited engaged in the business of manufacturing pharmaceutical products during the year ending. Sales, manufacturing, administrative, selling and marketing, finance cost. Asset purchased, know-how on 10th April is an intangible asset, 25% is the rate of depreciation. Plant and machinery to be used in manufacturing process in May, in December. Research and development for in-house training. Research equipment acquired during the year. Remuneration. Expenses for research and development. Contribution to institutions, national lab and university. The company has an opening WDV of 40 lakhs. The company had spent during the year 22 lakhs for construction of a research lab. The construction is not yet completed. Compute the taxable income of the company under both the regimes. Read through. Let us first compute the depreciation part. Okay, sorry. $65 lakhs into 7.5% plus 1 crore 40 lakhs minus 65 lakhs into 15%. 65 lakhs last purchased asset into 7.5%, 1 crore 40 lakhs minus already claimed 65 lakhs. So the remaining 75 lakhs into 15%. Here 25%. Hope you understand. Under normal tax regime, you can claim additional depreciation, whereas under the concessional or the new tax regime, you cannot claim. May I? May I?
Small doubt. We use the patent also directly or indirectly in the manufacturing process.
No, sir. Yeah, you use it. But that's why the law says only for plant and machinery. There are 4 categories of asset: building, plant and machinery, furniture, fixtures, intangibles. This is only for plant and machinery. In that used for directly or indirectly in the manufacturing. Other asset, sir, building, factory building is the prime place.
Also used for manufacturing.
But you cannot claim additional depreciation. I'm not doing in lakhs, I'm doing in absolute value. I want you to understand cost of lab construction. The term put to use is not there in section 35. Hence, as and when research expenses are incurred, the same can be claimed. So even though the lab construction is not completed, still you can claim it.
Expenses is 30 lakhs.
May I? Can I? A Limited engaged in the manufacturing, compute the deduction available. Okay, friends, homework. Please take it as homework. Next question. Swastik Chemicals has a research department and maintains registers of that department separately. The company had purchased the research equipment in the past years, 14 lakhs. Since the research process has been completed, the company intends to transfer the same. Currently, it can be sold for 16 lakhs. What is the tax treatment in the following cases? If the equipment is transferred directly. Are you clear? Are you clear? Okay. If the equipment is transferred to the block and then sold, the WDV of the block is 2650. Addition made in the second of 3 lakhs. Case C, WDV of the block is 10 lakhs. Addition made is 3 lakhs.
So when we say it is taxable under capital gains, it is long-term capital gains, it is itself for more than 2 years.
All depreciable assets will only have short-term capital gain.
But it is not a depreciable asset.
It is a depreciable asset. You are claiming 100%, so no depreciation. There is a difference between, it is not only 2 assets are non-depreciable assets, land and goodwill. All other are depreciable assets. Since you are claiming 100%, you are not eligible to claim depreciation. Is different from whether it is depreciable asset or not. 3 lakh into 7.5%, 10 lakhs into 15%. Can I? 10 lakh. Which one? KC is the block cease to exist. That's all. KC, there is a short-term capital gain. The block itself is gone. No more you can claim depreciation. This 180, how I got it? 3 lakhs into 7.5%. 1350 minus 3 lakh. 10 lakh 50,000 into 15%. Can I? If the company is amalgamated with another company and these equipments are taken over, we all know, remember that, okay? In case of succession, provisions will apply to transferee entity as it would have applied to transferor entity had the event not taken place. Always this is the ground rule. Provisions will apply to the transferee entity as it would apply to the transferor entity if there has not been a succession. So they will take over at the zero value. They have two options, either to transfer directly or to transfer to the block and then transfer. Am I clear? Okay. Moving on to the major section called section 35 AD, specified business. Moving on to the major section, okay, section, one of the prime sections which is going to travel with us, section 35 AD, specified business. Section 35 AD, specified business. Okay, the intention is to promote investment in certain sector. Listen to the story of how we have evolved in our tax regime. How we have evolved in our tax regime. This is just a story. Listen to it. In the 1980s, okay, we had a provision of 80H. HHHB, it will go like that. Okay, which are basically deductions. Okay, deductions of profits. Just listen. Okay, in the 90s, okay, Dr. Singh believed in section 10 exemptions, okay, 10, 10A, 10B, okay, exemption of income, okay, 10, 10A, 10B, 10C, 10D, 10I, okay, like that it went, okay. In the early 2000s, okay, Dr. P. Chidambaram, the then finance minister, brought 80I into the law, which is again deduction of profit, okay, which is again deduction of profit. Are you understanding? From an era of deduction, we went into exemption. Then in the year 2011, again P. Chidambaram, the then finance minister, felt this system is wrong. What are we trying to do? If you earn profit in these sectors, that profit is either allowed as deduction 100% or exempt. That's what we are trying to do. But actually what we want more people to invest in this sector. We thought profit is their motive. I mean, not paying tax is their motive. Exempting the profit or deducting the profit is their intention. No, my intention is make them invest. So, from a income-based incentive, Mr. P. Chidambaram moved us to investment-based incentive. So he brought 35 AD. Why do you allow profit or income? Let the investment be claimed as deduction. I want to promote these sectors. I want to make these sectors as profitable. So we shifted our thinking itself from an income-based incentive, income allowed as exemption, income allowed as deduction. We started investment is allowed as deduction, sir. We don't want you to just claim the income. We will allow the investment itself as a deduction. This is how there has been a shift of thinking. Okay, and that's the birth of section 35 AD. We identified certain areas where we don't have good investments. We identified certain areas where we don't have good investments. For example, agricultural country does not have good warehouse facility. Warehousing of agriculture is a problem for us. That's because of the perishable nature, we have to immediately sell it. We don't have a proper warehouse. We don't have a proper cold storage facility. We don't have hotels, hospitals, housings. So like that, we identified certain sectors and said, any investment in this sector, claim that investment as deduction. Claim that investment as deduction. Am I clear to you? Okay. So specified business, these businesses will qualify for deduction. Okay. Again, three categories. Okay. Conditions, deduction, consequence. Condition, deduction, consequence. Shall I? Okay. Condition number 1. It should be a specified business. Okay. It should be a specified business. My dear friends, to a larger extent in the question paper itself, they will use the word 35 AD or specified business. You need not remember all the 21 businesses that are there. On a broad idea, cross-country natural gas pipeline, agricultural storage warehouse, sugar, fertilizer. Okay, agriculture, sugar, fertilizer, pipelines, hotels, hospitals, housing projects. Okay, and your beekeeping and honey waxing. Okay, like that there are some sectors. Okay, you need not remember everything, just a broad idea is sufficient. 99% the question will say 35 AD or specified business. Am I clear to you? Okay, it should be a specified business. It should be a new business. It should be a new business. What is new? Okay, should not be formed by splitting existing business. What is new? It should not be a demerged unit. It should not be a demerged unit. It should not be formed by splitting up an existing unit. 80% of plant and machinery should be new. If you read the law, it should only use new plant and machinery. However, 20% can be second. So it technically means 80% of the plant and machinery should be new. Okay, once more repeating, it should be a specified business. It should be a new business. New business means not formed by splitting up, and 80% of the plant and machinery should be new. Okay, how will income tax department verify all these things? They want an honest person to verify all these things. Audit mandatory. Okay, I am seeing how many of you are laughing, and then I'll tell CA Institute, if I say honest, they are all laughing. Okay. Okay, audit mandatory. Okay, friends. Okay, friends. It should be a specified business. It should be a new business, not formed by splitting up, and 80% of plant and machinery should be new, and audit is mandatory. There is a small note here. Imported second hand machinery is considered new for this section. Imported second hand machinery is considered new for this section. Friends, not in general. It is considered new for this section. You cannot claim additional depreciation. There, this benefit is not there. Imported second hand machinery also only normal depreciation, no additional depreciation. But in this section, they say if the depreciation is not being claimed under Indian law. So imported second hand machinery is considered as new in this for this section. Am I clear to you? Okay. What deductions I can claim? 100% of revenue and capital expenses. Where current year is the first year of operation, where current year is the first year of operation, past period expenses can be accumulated and claimed. If current year is the first year of operation, even the past period expenditures can be accumulated and claimed. Past period expenditure can be accumulated and claimed. Are you understanding? Okay. Even the past period expenditures can be accumulated and claimed. There is no restriction on years. Scientific research 3 years, but here there is no restriction. Okay. However, we speak about exception. Cost of land, goodwill, and financial instruments cannot be claimed. Cost of land, goodwill, and any financial instruments cannot be claimed. No depreciation. No depreciation. Okay. No chapter 6A deduction. No chapter 6A deduction. The most important, which we all know, loss of specified business can be set off / carried forward and set off only against income from specified business. Loss of specified business can be set off or carried forward and set off only against income from specified business. Please understand. Please understand, it cannot be set off against anything else. Okay. Asset not to be transferred inter-unit for 8 years. Okay. Asset not to be transferred inter-unit for 8 years. Asset not to be transferred inter-unit for 8 years. Asset not to be transferred inter-unit for 8 years. Am I clear? Okay. Cannot be claimed under concessional tax regime. This section itself cannot be claimed under concessional tax regime. This whole section itself cannot be claimed under concessional tax regime. Read through once. Am I clear? Shall I proceed? Shall I proceed, friends? Okay. India Hotels Limited is running and maintenance of hotel, is in the business of running, and the company started a new 3-star hotel at Ayodhya. The company incurred capital expenditure 3 crores, land, building, equipment, special care zone, goodwill, financial instrument in the financial year 23-24. The entire amount was capitalized. In the financial year 24-25, construction and additional land. Operation of hotel commenced on 1st September 24. Case A. Compute the amount of deduction under 35 AD. Case B. If the company has a loss, how to treat it. Case C. There is another hotel in Kanchipuram which was established in 1980 and it has a profit of 50 lakhs, means will your provision undergo any change? Case D. Suppose I am not running the hotel, I only constructed the hotel and let it out on franchise model to another person from whom I am receiving royalty and rent. How will the provision be applicable? Read it. First, I start with a working note. No, main answer, sorry. First main answer itself, first question itself is this. Shall I? Expenditure during 23-24. Cost of land not eligible. Cost of building Yes, Jagan.
So the past period expenses, is it necessary that it have to be the immediate preceding previous
No,
year,
no,
or
no,
it can
no,
be
no, no. It can be any number of years. It can be.
Okay. Thank you.
If the company has loss from such business, how the same needs to be treated. Am I clear? Shall I move on, friends? Shall I move on? Okay, right. If the company has another hotel in Kanchipuram, which is earned a profit of 50 lakhs, what will be your change? There is another hotel in Kanchipuram which has earned 50 lakhs. Can the loss of this be set off in that? No. Why? Okay.
Can be set off.
Can be set off. Why?
Because just because the hotel was sold at the close so far that it's not a specific business. Be considered a specific business.
Okay. Right. This is a stunning interpretation which gives you a lot of clarity. Take your time in understanding this. Will this hotel fall under 35 AD? Hotel in Kanchipuram will not fall under section 35 AD. But is it a specified business? Yes. Why it will not fall under 35 AD? Because this section was not there at that time. This section was not there at that time. I gave you the history. I gave you the history. Had this hotel been started after 2010-11, had this Kanchipuram hotel been started after 2010-11, it would have come under specified business. So, extraordinary interpretation, Rajgopal was saying. What is specified business is different. What is section 35 AD is different. Like how I told him for capital gains on scientific research asset. It is an asset which is eligible for depreciation, but depreciation cannot be claimed because 100% I have claimed. So that capital gain can only be STCG. Same man. It is a specified business, but it is not falling under 35 AD because it is commenced before introduction of this provision. So the lawmakers said, boss, you can claim the deduction. You can claim the set-off. Sorry, friends. To continue, just I'm explaining so you can listen. It is a specified business, but it is not coming under 35 AD because the section was not introduced at that time. Now apply the logic. Loss from specified business can be carried forward and set off only against 35 AD. Did they say it like that? No. Only against the specified business. This is a specified business. This hotel is a specified business, but it was commenced before. That's why we cannot. Okay. Okay. Just check online students. Are you able to see the screen now? More clarity is there.
Not yet.
Not yet. That's what you're. Not yet is what you're saying. Okay. Case C answer. I'm dictating. You just start writing. Okay. Kanchipuram Hotel was established before introduction of this section. Kanchipuram Hotel was established before introduction of this section. It will not fall under section 35 AD, but it is a specified business. It will not fall under section 35 AD, but it is a specified business. By interpretation and clarification given by CBDT, by interpretation and clarification given by CBDT, by interpretation and clarification given by CBDT, the loss can be set off against the income of such other hotel. The loss can be set off against the income of such other hotel. That is the Kanchipuram hotel.
Clear now, sir.
Clear? Friends, clear?
Yes, sir.
Yes, sir.
Okay. Okay. This is a very good interpretation. We get a lot of knowledge in this, that business is different from section. Section might have been introduced late, but a business which has started before that might qualify to be a specified business, might not fall under section 35. Shall we? Shall I? Shall I? Okay. Kanna?
Sir, still the introduction of a new hotel will be considered as a new business, sir.
Once more, you can you ask that question?
Sir, because already they have a hotel in Kanjipuram, the introduction of the new hotel will still
Yes,
be
yes, yes.
considered.
Specified business means not just one. For any 2-star or above category hotel, whenever you construct, it will be treated as a specified business, not the first hotel alone.
Okay, okay, sir. Thank you.
Shall I continue? Case D is very more interesting. Suppose I am not running the hotel. I constructed the hotel and let it out. I am not many properties, Marriott, Taj, Chola, Sheraton's, Welcome Group. Many properties are owned by some other person, but they operate it. My dear friends, when I go and see in the specified business category, building and operation of new 2-star or above category hotel. Does that mean I should build and I should operate, or even if I do any one of these things, I will get the deduction. Is the and there conjunctive? Conjunctive means it should be together. I should build and I should operate. Or is the and there can be used disjunctive, building or operating.
It would be unrealistic to expect that the same company will have both the capabilities. So I think it should be, they should give them the benefit, either one page.
Taken, sir? Taken? Yeah, somebody is answering. Disjunctive. That's what he is. Very good answer. Supreme Court in the same India Hotels Limited held, what is the purpose of this section? If you invest, give the incentive. Investment based incentive. I may not have the expertise, but I have the fund. So I invest some other rent. The only difference is I should not construct it as a hospital and I should not construct it as a hotel and he rents it as a hostel. The purpose of construction and building and operating need not be by the same person, but the intention or the operation should be same. Okay, don't think this is not new. If you go down the Mount Road, you see government hospital. Okay, you see the government hospital. It was originally constructed as assembly building. Political divides made that as hospital. Okay, one government constructed it as assembly building, another government came and converted it into hospital. So it's not something new. It's not something new. So there is all possibility that building and construct, okay, will be by two different persons.
Screen is blurred again, sir. Can you just
Just give me a minute. Now check.
getting
Can I? Can I?
The screen is not clear yet, and your voice is also breaking.
So building and operating can be by two different persons. Okay. Continuing, my dear friends, to a very interesting question again. Mr. A commenced the operation of business of setting up warehouse facility for storage of good grain, sugar, and edible oil, which is not 35 AD, on 1st August 24. He incurred capital expenditure 80, 60, 50 for purchase of land and building in the financial year 23-24 and capitalized the same. The cost of land included in that are 50, 40, 30. So the building will be 80 minus 50, 30, 60 minus 40, 20, 50 minus 30, 20. This is building cost. Further, in the current year, incurred building cost of 20, 15, 10. Compute the income under PGBP for the year and the loss to be carried forward, that assuming Mr. A has fulfilled all the conditions specified under section 35 AD and has not claimed any deduction under chapter 6A. Okay, the profits from the business of setting up a warehousing facility before claiming 35 AD or 32 is 16, 14 and 31. Read through. I will reduce it a bit so that we are able to work out the question. If it is very blurred, let me know. Computation of working note. Working note for capital expenditure. Working note for capital expenditure. Is the visibility okay, friends?
Yes, sir.
1 second.
So why is depreciation under section 3 lakhs? 20 lakhs the last year, 2 lakhs claimed.
Yeah.
Therefore,
So what our friend says is 20 lakhs. I would have claimed 2 lakhs last year. So the opening WDV is 18 lakhs. Add 10 lakhs, 28 lakhs into 10%. 2,80,000 should only be claimed. But the answer is put to use. Last year it is under construction. Business started only on 1st of August. So it would have been put to use only from 1st August. That's why I am saying that entire depreciation, our depreciation starts from this year. Clear? All of us clear? Online friends, you have taken down? May I, friends? May I? Okay. I request you to ignore the next question. I will give you the answer today. I will send you the answer. It is a question where you can understand 35 AD in depth. That's why I have given not with an examination intention. I somehow failed to ignore it. I failed to take it out. I will give you the answer. Once I give you the answer, you can go through the question once and see whether you have understood. I'll send you the answer today by message so that you can check the answer. You will be able to understand it. Okay, there are some things like you can see plant and machinery. I'll take some time to explain you. Old plant and machinery 2 lakhs from domestic market. This is second hand. These two are new. If I import a plant and machinery, old plant and machinery, it becomes a new machinery. My dear friends, you can see here. Okay, see, check for condition. New plant and machinery from domestic market 9 lakhs. second-hand imported plant and machinery. For this purpose, for the purpose of this section, it will be only taken as new. So, out of 15 lakhs, these two are considered as new. These two are considered as new. This alone is considered as second-hand.
The voice completely
Voice is breaking up. Hearing me, online friends? Online friends, can you text me if you have an issue? So friends, this is the 15 lakhs, out of which 2 lakhs is only coming to less than 20%. 2 lakhs is only coming to less than 20%. Okay. And then the total cost, which I will send you, okay, which I'll send you, you will see IFOS in this question, which you cannot set off against the IFOS income. That is this question. I'll send you the answers. I'll send you the answer. The only extra feature is that plant and machinery will be checked in this particular question, not from the examination perspective. Just it's a own question, so that's just worked out. Okay. So one of the principles we discussed is asset should not be transferred inter-unit for 8 years. What is this condition is all about? You should understand. You should understand. My dear friends, I purchased an asset for my specified business. What happens? I claimed 100% of the expenditure. Next year, I transferred the asset to my non-specified business. Which is wrong? Which is wrong? That means so I purchased it for sugar division and then taken it to edible division. I purchased for my sugar division where I claimed 100%. Next year itself, I transferred it to my edible oil business. The law does not allow this. The law says reverse. Reverse the expenditure as income. You have claimed the purchase cost, no? That should be reversed as income. And the assessee said, sir, I was unable to use it. Had I purchased it for edible oil business directly, last year itself I would have claimed the depreciation. The law accepted to that. The law says, okay, income will be asset value minus depreciation had it been used for the purpose of non-specified business from the date of its purchase. From the date of its purchase. Okay. Heading inter-unit transfer. Heading inter-unit transfer. Where an asset purchased for specified business is transferred to non-specified business within 8 years, then the expenditure already claimed which is nothing but the original cost of the asset, minus depreciation. Had the asset been used for non-specified purpose from the date of purchase, will be recorded as income. ABC Limited is a company having two units. Unit A carrying on specified business of setting up and operating a warehouse facility for storage of sugar. Unit B carries on non-specified business. Unit A commenced the business from 1st April 22 and claimed a deduction of 1 crore under section 35 AD for two buildings used for the purpose of business. However, in Feb 2025, Unit A transferred one of the building to Unit B, examining the tax implication. April 22. This should be the income that needs to be recorded. This should be the income that needs to be. That is, had the asset been purchased for this specified business long back, what would have been
So screen again blurred.
Is it okay, friend? Kavya, is it okay?
Ah, yes, sir. Okay.
So had the asset been purchased for this specified business some few years back, now find out the depreciation every year and the remaining will be treated as income. Now this will be the cost of the asset in that new non-specified business and they will claim depreciation on this.
So information used until February 25, 11 months.
Depreciation is a 31st March concept. If you want to know the value, you can know only on 1st April, not on any other date. That's income tax law. That's the beauty of income tax law. One time only. Am I clear to you? Okay. Let's take the breakfast break. Come back and start doing the other parts of section 35 and hopefully we complete 36, 37. Meet you after the break. So, the two important parts of section 35, that is scientific research and specified business are over, which are really important. Now I am going to the other parts of section 35. Shall I? social welfare deductions. Social welfare deductions.
But with 35 AD not being available in the concessional tax regime institutions.
35 AD is not available under concessional tax regime. Of course, yes. We wrote it, right?
No. So it's losing its relevance. We have
Yeah.
70% by
Yeah. Concessional tax regime just kills the incentives of taxation. Accepted. Agree. Social welfare deduction. Okay.
Take 1 minute, sir. The project review.
Or the next option is you have to wipe your glasses. Okay. Social welfare deductions. There are basically 3. Contribution to projects of national committee. Contribution to projects of national committee. Contribution to projects of national committee. Agricultural extension program. Agricultural extension program and skill development. Okay. Contribution to national committee, agricultural extension program and skill development. CCA, CC, Triple C and CCD. Whole of the contribution allowed. Whole of the contribution allowed for companies direct spending is also allowed. Direct spending also allowed. Okay, this can be a rural development project, anything which will be approved by the national committee. Some schools, you see some schools, this block is contributed by India Cements, this block is by Infosys. So it can be a whole of the contribution allowed, and direct spendings are also allowed. Direct spendings are also allowed. Okay. Agricultural extension program, fully allowed. Except cost of land and building. Except cost of land and building. Skill development. skill development only for Indian company. So a firm, a sole proprietary, a cooperative cannot claim it. Only for Indian companies. Only for Indian companies. Fully allowed. Except cost of land and building. Except cost of land and building. For all the three, put a bracket under and write not allowed under new tax regime. Not allowed under new tax regime. Am I clear? Am I clear? Okay. So, rarest, I have not seen questions. Skill development alone, remember. Skill development alone, remember. Amortization. What is amortization? Writing off an expenditure in multiple installments. Accountancy calls this as deferred revenue expenditure. Income tax law calls this as amortization. Writing off an expenditure in multiple installments. Okay, right? Our income tax law divides this into over 5 years, over lifetime. Over 5 years, some expenditures are written off over 5 years. Some expenditures are for the lifetime of that particular asset. Am I clear? Okay. Section 35AB. Telecommunication license. Telecommunication license. So, suppose I am paying some 10 crores and getting 10 years license, 1 crore every year over the lifetime of the asset, over the lifetime of the license. Are you understanding? Okay. ABA. Both allowed over period of license on payment basis. On payment basis. As and when you pay, you can claim it. Let us take, for example, 10 crores is the value of license. First year I pay 4 crores. Only 4 crores can be amortized over 10 years. Next year I pay another 3 crores. That 4 crores plus this 3 crores divided by 9 years. Like that it will go on. Only on the basis of payment, telecommunication license and spectrum fees will be. Now I'm taking a small deviation. taking up one thing from section 36, one thing from section 36, and telling you there is something known as zero coupon bonds or deep discount bonds. Repeating, there is something known as zero coupon bonds or deep discount bonds. What is that? 100 rupee bond issued for 60 rupees. No interest will be paid. That's why zero coupon. 5% debentures means 5 is the discount. 5% is the zero coupon. After 10 years, I will redeem it for 100 rupees or at a premium 110 rupees, etc. So this 40 rupees, technically, law might call it as discount, but practically, this is the interest. This is the interest. So the lawmakers say, so income tax law say, write it off over the period of, so 40 rupees. 1 crore bonds are issued, 40 crores divided by 10. Every year 4 crores. Okay, right? Zero coupon bonds, section 36. Zero coupon bonds or deep discount bonds. Difference between issue price and redemption will be amortized over the lifetime of bond. Difference between redemption and issue price will be amortized over the lifetime of the bond. Will be amortized over the lifetime of the bond. Are you all understanding? Okay. All right. Not section. CBDT circular. Okay. Expenses on, you know what is BOT stands for? Build, operate, transfer. Larsen and Toubro lays a national highway. Build. 10 years, you get the toll charges. You can collect. After that, transfer it the asset to the government. Build, operate, transfer. So I have laid the road. That is not my asset. That is an asset belonging to the government. So I cannot claim depreciation. Whatever is the cost of that road can be claimed as amortized over the period of my license. Okay, build, operate, transfer. Expenses on board can be claimed, can be amortized over the period of asset license. Or you can even write it as over the period of operation. Metro project also, correct. They'll do depreciation. Yes. Am I clear? Okay. Now, over 5 years, Section 35D, preliminary expenses. Section 35D, preliminary expenses. Okay, preliminary expenses means before incorporation or at the time of expansion. Both are preliminary expenses. Preliminary expenses is before commencing the business or every time I am already in the business of manufacturing tubes. Now I am manufacturing tires also. Whatever expenses I incur for tire sector is my preliminary. I'm already in the software. Now I am increasing to hardware. I'm already in the film line. Now I am expanding to OTT. Okay, every expansion also whatever you spend is preliminary expenses. Qualifying amount. Actual preliminary expenses are 1/5 of either cost of project or capital employed. Whichever is less. Whichever is qualifying amount. Actual preliminary expenses or 1/5 of, you can take any one, whichever is higher, that you can take it. Whichever is less, which will be amortized over 5 years. Once more repeating, actual preliminary expenses are 1/5 of any one of these. So I'll always take whichever is higher. On that 1/5 I will take. Okay. Whichever is on that whole, whichever is less can be amortized. Am I clear to you? Okay. Section 35DD, amalgamation or demerger expenses. Amalgamation or demerger expenses. Section 35 DDA, VRS compensation. Voluntary retirement scheme compensation. Voluntary retirement scheme compensation. And again, moving out, section 36, to be very precise, 1 subsection 9, but not needed all these things. You can write section 39, expenditure on promotion of family planning. Amongst employees. Expenditure on promotion of family planning amongst employees. Expenditure on promotion of family planning amongst employees. Expenditure on promotion of family planning amongst employees. Only for Indian companies. revenue expenses fully allowed. Revenue expenses fully allowed. Capital expenses allowed in five equal installments. Allowed in 5 equal installments. Read.
Sir, under CBT circular, what is BOT, sir?
Build, operate, transfer.
Based operate transfer.
Build, operate, transfer. There are totally 8 amortization. 4 on the basis of lifetime, 4 on the basis of 5 years. Preliminary expenses, amalgamation demerger expenses, VRS compensation, capital expenditure on promotion of family planning incurred by an Indian company. All these are for a period of 5 years. 4 on the basis of lifetime. Telecommunication license, spectrum fees, zero coupon or deep discount bonds, and BOT expenses. BOT alone, CBDT circuit.
License payment or license payment basis.
That is totally 10 crores. 10 crores divided by 10 years. But this year I am only paying 4 crores. The government has given me pay year 1 4 crores, year 2 3 crores, year 3 3 crores. So this year I can only amortize 4 crores and not the entire 10 crores because I am not yet, I am now uncertain the other 6 crores whether I will pay or not. So as and when you pay it for the remaining number of years, you please write it.
Sir, in qualifying amount, section 35D, we should take 5% of capital employed only, no, sir?
5% of either cost of project or capital employed. So suppose cost of project is 10 crores, capital employed is 12 crores, take 5% of 12 crores.
Which have to be compared with the actual preliminary.
Whichever is less. Very good.
Okay, sir.
Step 1, actual preliminary expenses. Step 2, either capital employed or cost of project, whichever is higher into 5%. Step 3, this a step 1 or step 2, whichever is less. That is known as qualifying. May I? I'm there in question number 18. X Limited providing telecommunication services acquired a telecom license at a cost of 50 lakhs. Assuming the telecom license is transferred in 24-25 for 32, 43, 52, and if the whole or part of the license is transferred, explain how the transfer will be dealt with under income tax law. Read through. Okay. License fees paid on 1st April 22 is 50 lakhs and the license is valid for 10 years. Less amortization for 22-23 and 23-24, 10 years, so 5 lakh every year. WDV of license on 1st April 24. Less whole of the license sold, 32 lakhs, 43 lakhs, 52 lakhs. Profit on sale, loss on sale to be debited to P&L account. Loss on sale to be debited to P&L account. Profit on sale to be credited to P&L account. And then
Applicants.
very good. 12 lakh. Always if you sell more than original cost, exactly I'm waiting for that. so that I can put it in your mind once for all. Whichever asset it is, when you sell more than original cost, it is capital gains. Capital gains. That is in excess of original cost. Okay, okay. When sale of part of license, they don't sell the whole of the license, they sell only the part of the license. Okay, less sale value of part of license. Balance in the license. This will be amortized over the next 7 years. Okay, to next 8 years. Next 8 years. That is 1 lakh per year, because there is only a part sale. So the remaining can be amortized over the next 8 years.
Basically, like removing the clock depreciation.
Yeah, okay. You can draw a parallel like that. The other two are anyhow more than the, so income has to be recorded. Once more, from the top, I'm coming now. Section 30, expenses in relation to building. 31, expenses in relation to plant, machinery and furniture. 32, depreciation, normal, additional, proportionate, unabsorbed. 33, AB, development account, plantation sector. 33 ABA, oil and natural gas. There is no 34. 35 scientific research, 35 AD specified business, then social welfare deductions under 35C, and then a mixed sections of amortization, totally 8 amortizations which are covered under the law.
The telecom license spectrum fees are industry specific.
Yes, yes. That's why the questions will not come. You are very, very correct. Very niche sector of the population are only covered in that. Nowadays, the government is also not very keen on these license fees. They also ask you pay yearly. Why should I get one time and you are not, you pay yearly. That's how the government nowadays changed their policy. In which case there is nothing to amortize. May I? May I?
So can you explain part of the license rule again?
Yeah, part of the license. So suppose I get that license for whole of South India. I sell the Andhra Pradesh portion of the license alone. I'm still going to, or Andhra Pradesh and Karnataka I sold, I'm still going to operate Tamil Nadu and Kerala. So what happens? The sale value will be reduced and still the whatever is the balance, because the license is still with me. Not that the entire license is gone. Not that our friend was saying, no, draw a parallel like block of asset. The entire block is not gone. So the license is still there. So whatever is the license fees, remaining years, 8 years, totally 10 years, 2 years already amortized. 2 years already amortized. Remaining 8 years, whatever is the balance license fees, you amortize. But if the sale value is more than the license value, nothing can be done. Block is gone. Let the assets be there. Block is gone. The same path. Can we? Okay. Section 36, other deductions. Section 36, other deductions. Section 36, other deductions. First, I will speak about two deduction and then speaks about the, okay, here, even though other deduction, they have given a list of other deduction. There are many. First, I will condense it into for employees, for stock. So what expenses, if I pay to an employer, pays to employee or pays on behalf of employee, what will be allowed? A, group insurance premium, which can also be personal accident premium, together we start, which can also be personal accident, etc. Group insurance premium covering for all employees will be allowed. Group insurance premium will be allowed. Bonus or commission. Of course, later I am going to say this is subject to 43B. When we come to 43B, we will understand the overruling nature of it. Okay, bonus or commission. Okay, bonus or commission is allowed. Okay. employer's contribution to provident fund except unrecognized provident fund. Employer's contribution to provident fund except URPF. UR stands for unrecognized. Okay. Employer's contribution to superannuation fund. Employer's contribution to superannuation fund. Employer's contribution to gratuity fund. Employer's contribution to gratuity fund to the extent of 8.33% of salary. To the extent of 8.33% of salary. Okay. 1 month salary. That's what it is. 8.33. F. Employer's contribution to pension fund. Employer's contribution to pension fund to the extent of 14% of salary. To the extent of 14% of salary. Am I clear? 4 different contribution. First 2, no limitation. Provident fund and superannuation fund. Next 2 with limitation. Gratuity fund and pension fund. Gratuity 8.33. Pension fund 14%. Salary is equal to basic pay plus DA forming part. Salary is equal to basic pay plus DA forming part.
National Pension Scheme is called
Sir?
NPS.
NPS, why will employer contribute? That's what this pension funds.
Yes.
This pension funds. Okay. Okay, friends. Okay. So, employer contributing to all these things will be allowed under 36. Now comes for stock. Insurance premium. Write-off. Security transaction tax. commodity transaction tax. All these things are allowed for stock. Okay, stock includes livestock. Okay, stock includes livestock. Stock includes livestock. So the expenses, other deductions for employees, for stock are so much. Okay, these are all falling under section 36. Okay,
Stocks are inventory stocks are
inventory. If you're a stock dealer, then security transaction, because stock become your securities become your stock. If you are a company who is investing surplus funds in shares and securities, STT will not be allowed. That's why they are very clear. STT and CTT will be allowed only if the security or commodity has held as stock in trade. Am I clear to you? Okay.
1.A there is a provision. Yeah, on a security transaction, tax is paid in on the 1 lakh person deduction. That is for capital gains.
That is that is altogether different. That is again, as you said, capital gains chapter. Shall we, friends? Okay. Now others, other than employees, and I am dividing again. I am in section 36 only. Okay. Other than employees and stock. Provision for bad debts. Provision for bad debts only to bank and financial institutions. Only to banks and financial institutions. For domestic bank, for domestic bank, 8.5% of total income, 8.5% of total income plus 10% of rural advance. For domestic banks, 8.5% of total income plus 10% of rural advance. For foreign banks and financial institutions, 5% of total income. 5% of total income. May I? The total income. Then is bad debts allowed. Whatever is the bad debts allowed. The only thing is it should be bona fide. It should be bona fide. Genuine bad debts, and to be written off in books also. In the books also it should be written off. Interest on borrowing allowed, provided loan is used for business or profession. Allowed, provided the loan is used for business or profession.
But 43B will override this section.
Obvious, notwithstanding is the words. Am I clear? Apart from this, we have seen already family planning expenditure and also zero coupon loans. This is section 36. Okay. Employees insurance is covered in section 36. Stock insurance is covered in section 36. If I insure assets, I cannot claim deduction. Huh? If I insure year on year, I cannot claim.
General deduction.
General, that is, you say it is claimed under 37. That's what you say, Rajagopal?
Yes, sir.
Yeah, I take that answer. But I also say that poor memory, 30, 31 visa. Insurance. Insurance on building. Insurance on plant machinery. Okay, we have seen. So that's how sections fall. I'm just asking you to also understand how they make their fall. If they put in insurance for stock asset here, then asset-based section loses its significance. Any expenditure on asset, go and put it there. Here, other than those things only will be good. That's why you think assets insurance cannot be claimed, or it is not specifically mentioned. No, it is specifically mentioned. Am I clear to you? Okay. One question in 37 is that pension. Oh, Brad. Question number 19. The following particulars is in respect of a scheduled bank. Opening bad debts, gross total income, average rural advance, bad debts written off in the books of the accounts. Compute the deduction under income tax law.
8.5% of total.
Sir, once more, sir.
And then
Yeah.
8.5% of total.
This you understood? The total provision that I can claim in the financial year 24-25 is 98 lakhs. Can I? 98 lakhs total provision that can be claimed. Now understand, actual bad debts to 10 lakhs. Is that correct? Is that correct? Actual bad debts as per books of accounts to 10 lakhs. Okay. Where there is a provision, bad debts has to be adjusted against the provision, not against income. You all agree with me? If I have a provision, that's accountancy concept. I will claim bad debts also a provision also, not correct. You are claiming provision because whenever there's an actual bad debt, you will write it off against the provision. Okay. Actual provision available, opening balance 100 lakhs plus current year provision 98 lakhs. So 198 lakhs. Bad debts to be written off separately is only 12 lakhs. Are you understanding? If you have 210 lakhs, you cannot claim 98 and 210. That's not the right manner. And already you have claimed 100 lakhs. That's why it's there in the opening. So whatever accountancy, whatever provision is there, whatever bad debts is there, first adjust it with provision. If you are further to be claimed separately. Am I clear? Any doubt? That all actually good. I mean, P&L in income tax we can claim it. Employer contribution to pension fund. X Limited contributes 25% of basic salary to the account of each employee under a pension scheme. Dearness allowance 40% and it forms part. Compute the total deduction allowable under section 36. If the basic salary is 10 lakhs, would disallowance be attracted? If so, to what extent? Okay, we will.
What's the difference between a pension fund and a superannuation?
Superannuation fund, no. Superannuation fund is not mandatory, whereas pension fund is mandatory.
Conceptually, superannuation and pension basically similar.
Once more.
Conceptually, annuity and pension operate similarly.
Yeah, correct. Basic pay plus DA forming part into 14%. So what is the basic pay? 10 lakhs plus DA forming part is 40% of basic pay. So 40 into 12 into 14%. So it will be only disallowed under 36, not under 40. May I? Tell me.
Generally, companies are allowed to have their own PF fund, correct?
Yeah, companies are allowed.
Those are not considered as unrecognized your PF.
No. They are recognized provident fund. Statutory provident fund run by government. Recognized provident fund run by people which are approved by both Commissioner of Provident Fund and Commissioner of Income Tax. One which is not approved is only known as unrecognized.
Sir, one request, sir.
Go ahead, friend.
Sir, can you please discuss yesterday's homework question before ending of this session?
This is for biogas and computers.
Sir, why we calculated different head? Should it come under one block?
No, no. How can it be? These are two different assets. They cannot be clubbed. And this is for building.
Sir, it is for dwelling purpose, so the building percentage, 5% will
5% is dwelling means some business activities. Residential building, then only 5%. Further, I'll give you one more answer. The law says, had the building been used for official purposes right from the date of purchase, so it can only be 10%. Am I clear? Shall I move on?
Yes, sir.
Thank you, Maharaj.
Asked the to use only on 1st March, so we claim a 24 half depreciation of depreciation.
Half.
In the homework.
In the homework question. 1st March of 2025.
Years.
In the question number 4C.
Yes, sir, in 4C only.
I should claim only 20%. I should only claim 20%. If it is put to use for less than 180 days, I should only claim 20%. Please change accordingly. Please change accordingly.
Yes, sir. Now clear. Thank you so much, sir.
May I go to section 37? Okay. Section 37. General deductions. Section 37. General deductions. And remember, here there is no list. There is no list, though I will later write down 3 items separately mentioned. Otherwise, there is no list in section 37. Friends, the law just says few conditions. If you satisfy those conditions, the expenses will be allowed as deduction. Okay. 5 conditions. not mentioned under section 30 to 36. The expenses are not made, because if it is mentioned there, don't come here. If it is mentioned there, don't claim depreciation in 37. Don't claim employer's contribution in 37. Don't claim scientific research in 37. It's already there. If it is not, then there. Remember, 75% of our P&L account will fall in section 37. Purchases, you haven't seen a section. Rent, which is a bigger expenditure. Salaries, which is a bigger expenditure. Traveling, printings, advertisements, maintenance. So 70.
30 lakh.
Sir?
Rent 30 lakh.
Rent 30, yes, sir. So 75% of our expenditure, there is always a possibility it is falling under 37. Okay, this is why this is more important. Not mentioned under 30 to 36. Not a capital expenditure. Not a personal expenditure. Incurred for the purpose of business or profession. Incurred during the previous year. 5 conditions for allowing an expenditure under section 37. It is not covered under 30 to 36. It is not a capital expenditure. It is not a personal expenditure. It is incurred during the previous year for the purpose of business or profession allowed. If everything is a tick mark, it is allowed. Am I clear to you? Okay. Not mentioned under 30 to 36. Traveling expenses, not mentioned. Traveling expenses for purchase of machinery. It is mentioned in 32, and also it is a capital expenditure. Personal travel expenses will not be allowed. Traveling expenses for new business or profession will not be allowed, because we already saw preliminary expenses means also those which are incurred for expansion of activity. But I want you to understand one thing here. This is the statement which tells us income tax law does not recognize, does not allow prior period items. This is the statement. Strictly interpreting this statement will make us allow, we understand, prior period items not allowed. Not allowed. Expenses should be pertain to. You will ask, what if I find a prior period item later? Income tax law says file a revised return. What if I find a prior period item beyond the revised return? I'm very sorry, friend. That's what income tax law strictly says. Not that nobody is claiming, but as a student, from the academic perspective of it, incurred during the previous year means prior period items, it should pertain to the previous year, and prior period items are not allowed under income tax law. Expenditure which are not covered under section 30 to 36, which are not of capital nature, which are not of personal nature, which are incurred for the purpose of business or profession during the previous year, is allowed as deduction. Is allowed as deduction. Any doubts? Any doubts? Shall we move on? Shall we move on? Having said that, Section 37 speaks about 3 items which are important. Okay, which says not allowed. Penalty. Friends, section 37 says penalty will never be allowed. What is penalty? Violation of law. Inland and foreign. Okay, both inland and foreign. If you pay any penalty, it will not be allowed as deduction. CSR expenditure. CSR expenditure in income tax law under section 37, they say it is not allowed. Political contribution or advertisement in the publication of political parties. Okay, neither political contribution will be allowed nor advertisement in the publication of political parties will be allowed. It will not be allowed. Advertisement, neither political contribution nor this will be allowed. Having said this, okay, 80 GGB or GGC can be claimed. For this, 80 GGB or GGC can be claimed, provided you are in the old tax regime. If you are in the new tax regime, this is also not there. Am I clear to you? Okay. Okay. Let us understand this. You want the sheet? Let us understand something which I am going to take you to a small journey. Okay. A pharma company gives gift samples to medical practitioner, that is nothing but doctor. That is nothing but doctor. Please listen, that is enough. Okay, listen, and that's it. Code of ethics. Code of ethics. You know what it is? It is also there for us. Okay, right? When I was studying CA final, 12 auditing marks. So we studied code of ethics. After that, we forget. Okay, right? So trust me, it is also there for us. Code of ethics for medical practitioners says they should not accept anything from pharma companies. They are not supposed to, because then you will prescribe that medicine only. To avoid such unfair practices, Code of Ethics said you are not supposed to get anything from a pharmaceutical company. Okay. Indian Council for Medical Ethics and Standards said this was medical regulations, said you should not accept it. Now, an expenditure incurred here, which is an expenditure incurred here, which is in the nature of gift and samples to doctor, is disallowed because he is not supposed to receive. Pharma company said, boss, he is not supposed to receive. CBDT circular said, a pharma company giving any gift or practice, any other benefits to a medical practitioner is against the provisions of Indian Council of Medical Regulations, where the medical practitioner is not supposed to receive it. So it will not be allowed as deduction. Pharma company challenged that CBDT circular. See, he is not supposed to receive it. That the ICMR never said pharma company should not give it. The receiver, if he is not going to receive, why are you going to give? Why are you disallowing for me? Configuration of Indian Pharmaceutical Association went on a case against the CBDT circular challenging its validity. High Court said, boss, yes, you are not supposed to give it to him. He is not supposed to receive it from you. What is prohibited for him is prohibited for you also. So it is. One of the companies in the, and they dropped it there, but one of the companies in the Confederation of Pharmaceutical Federation is Apex Laboratories, Chennai based. Apex Laboratories went to Supreme Court challenging that, saying, boss, I don't understand your logic. When he is not supposed to receive, why are you not allowing it to me? Supreme Court also said, no, this is violation. It is not allowed. Am I clear to you? Am I clear to you? Okay, this is the story of a firm. Yesterday I was telling you. Now, if a pharmaceutical company is giving to a doctor, to me it is not allowed as an expenditure. For the doctor, it is an income, any perquisite or benefit received in the course of carrying on of business. I am not allowed that expenditure, but I am supposed to deduct 194R. What if I don't deduct 30% disallowance, 100% disallowance? Because anyhow, it is not allowed as an expenditure. You got your point? You got to understand this. When the Apex Laboratories case was going in the Supreme Court, income tax law amended the definition of penalty to include something. Violation of law is also penalty, and payment or providing benefit which the receiver is prohibited from obtaining.
Is this only for samples or all the tours that they sponsor for doctors?
All the tours they are sponsoring for doctors are not allowed, sir.
Even, okay, irrespective of whether they deduct tax or not.
Yes, sir. Yes, sir. Yes, sir. Yes, yes, yes.
Then why will they deduct TDS? Anyways, it's not allowed.
I'll just continue for the second part of the story. Please wait. Not the second part of the story, the second aspect. So this is also penalty. Please remove. Now, a doctor refers patients to a particular scan center. And the scan center pays doctor referral fee after deducting tax at source. Now tell me, Rajagopal, is it allowed?
Commission,
Is
not
it
allowed. Should not be allowed.
should not be allowed? A doctor is supposed to say, get it scanned. Get it scanned at this place is
Behaving like commission agent.
violation. Get it scanned at this place is violation. Not allowed. Not allowed. Are you understanding? It is not allowed. So that takes the cap. Just because tax is deducted, it does not ratify the main criteria that it is a penalty. And secondly, as he said, why should I deduct tax? Anyhow, you are not going to disallow 30%, you are going to disallow. That is a separate thing. Because 271 penalty will come for not deducting tax. Okay, expenses also paid, penalty will also be paid for not deducting tax. That's why we don't, we try to deduct tax. That's a separate thing. Don't worry about it. But remember the penalty definition has been amended by section 37, okay, to include, okay, to include something. Look at this. Expenditure which result in benefit or perquisite to a person, whether or not carrying on business, and acceptance of such benefit or perquisite is violation of any law, rules, regulation. Okay, person. Okay, right? So please ensure that you read code of ethics. Okay, and understand what is allowed for the client. Okay, so this is how this particular aspect of it. Remember, penalties are not allowed. This okay. CSR expenditure not allowed. Political contributions not allowed. Other than this is okay. This is Confederation of Indian Pharmaceutical Association, CAPSCAN, and Apex Laboratories. In these three cases, medical industry specific cases where it has been disallowed. Am I clear to you? Am I clear to you? We'll start with case laws tomorrow morning. We'll start with case laws tomorrow morning. Tomorrow, we'll complete all the provisions. We will complete all the provisions and be ready for a day after tomorrow to wind up PGBP. Okay, to wind up PGBP by day after tomorrow. Tomorrow, we will be able to complete all the provisions. Okay, what is pending is quicker provisions only, but important provisions, quicker provisions only. Okay, meet you tomorrow at the same time. If you have any queries, any feedbacks, you can directly message me. You need not wait me to put a quiz. You can directly message me. All the best.